Anaona
Hello, please can you hear me? Hello?
Yes, please.
Please, can you hear me?
Yes, sir. We can hear you.
Okay, okay, that's fine. So, good morning to you all once again. Um, I'm a facilitator for the intervention class. I'm by name Jude Prince Edufojo, and I teach basically financial accounting here at Flourish Professional Institute. I also teach introduction to cost and management um, at different places too. Yes. So all the level one I can teach you together with the level two. Uh-huh. So what we are going to do basically this morning is to get to know how to go about the questions when we are being presented with the questions in the examination, how to go about them. We first to go about objective questions because what you are going to do is an objective test. Okay, so going about an objective question, the first thing you should do is to pay particular attention to the items highlighted in the question. Okay, so be it written, be it calculation, pay particular attention to the question being given to you. Okay, because what I've realized over the years is that students don't really pay particular attention to the question and they just select an answer. The painful aspect will be that you know and you go and select a wrong answer. That would be very painful. So when you are doing the exam, as much as you are also, what do we call it? You are working with time. You have to be also cautious and patient when tackling the questions because you know the thing, but because of haste, you just select any answer and move ahead. So we have to be very what careful when selecting our answers. Okay, we have to be very careful when selecting our answers. So yeah, so we have to be very, very what careful when answering the questions. Okay, take our time to analyze the question before because especially with the calculation. Okay, with the calculation, take our time and analyze it before we tackle the question. So yeah, so you are welcome. You are all welcome. Rani, Precious, Mr. Suleiman, Isaac Apia, and I think the rest. I'm not really seeing you, but you are all welcome for the session.
Okay, thank
Um,
you.
you are welcome. So you can also, it's also being streamed on YouTube, so you can also alert someone who is also doing financial accounting to also join via YouTube or anywhere. Okay. So sometimes so I realize students when you give the answers, they will also want proof. So when I give you the answer, I'll show you the proof from the manual too, so that you be okay. Okay, so I have a list of questions here. Okay. Then the mock question too is here. So let me also then an ACCA question too is here. So okay, so that's fine. Okay, so financial accounting at the ICA level, level one paper. Um, so you are not going to write it at this date. This was for March. So you are going to write financial accounting on Tuesday, right? Tuesday, that's I think when is it first? Is it first? First, right?
Yes,
Are you
first.
going to write the paper on first?
Yes, first. That's Wednesday.
That first is Wednesday. Okay, so Wednesday. So you'll be writing the paper on Wednesday. So take note so that you don't forget. Cry. Mhm. So the areas that are most examinable in our syllabus. One is Introduction to Business and Accounting. And under Introduction to Business and Accounting, we studied the forms or types of businesses. Is that not it? We looked at accounting in general, the difference between accounting and management accounting, right? We also looked at um, the introduction to accounting. Under there, we looked at bookkeeping, the difference between bookkeeping and accounting, whereby we said that bookkeeping is slightly different from accounting, and bookkeeping is an aspect of accounting that deals with only recording of business transaction. But when we look at accounting, accounting is very broad. Accounting is very wider in scope. So with accounting, it involves bookkeeping, journalizing. You also do summarizing, classification, and reporting of financial information to the users. Okay, so accounting doesn't just end with bookkeeping. It goes further towards summarize, classify business transaction. It will also communicate it to the users. And we know that in business world, the users are categorized into two main users. We have the internal users and we have the external users. Internal users are those within the organization, and that is where cost and management accounting focuses on. So we focus on the managers, we focus on the employees. That's internal users. And the external users are your shareholders, your bank, customers, suppliers, or vendors. Okay. Uh-huh. So those are the external users. So we looked at all those things. Then we also came to double entry. And under double entry, we looked at accounting equation, journals, ledgers, and trial balance. We looked at what? Accounting equation, journals. So journals are the same as day books. So if maybe you are seeing journals and you are confused, it's the same as day books. Okay. Then ledgers, then trial balance. We did all those. So they are also examinable. Correction of errors and suspense account. So using general journal to correct errors using suspense account to correct errors. And we looked at types of errors. We have that affect errors that affect the agreement of the trial balance, and errors that do not affect the agreement of the trial balance. And we also look at extended trial balance. Errors that affect the agreement of the trial balance simply means that errors which will not cause the trial balance to balance. Because whenever you prepare the trial balance, your debit and your credit will have to agree. So if the debit and the credit is not agreeing, then it means that there is a particular error which was done at one side of the account. Normally, those errors are committed at one side of the account. So if the debit was done wrongly without the credit, or if the debit was done correctly without a credit, it will not balance. If the credit was done wrongly, and if the credit was also done correctly and the debit was done wrongly or was omitted, then the trial balance will expose it. Uh-huh. So that is what we mean by errors which affect the agreement of the trial balance. And errors which do not affect the agreement of the trial balance normally happen with regards to two sides of the account. So let's say you have completely reversed an entry, complete reversal of entry. So it means that what was supposed to be debited, you credited it, and what was supposed to be credited, you debited it. This one, everything will balance, but you are wrong. Another error is error of omission. You completely omitted everything. So there was neither a debit, neither a credit. The trial balance will still balance, but you are wrong. We also have error of commission. Commission, the one that you say due to name similarities, error which is due to name similarities. That one too, when you commit it, the trial balance will balance okay, but you are wrong. So those are the errors that do not affect the agreement of the trial balance. Someone will even say error of transposition. But I always tell my student that error of transposition comes in both sides. It depends on how you explain it. So error of transposition refers to where a figure has been what misplaced or misarranged. Okay, that is the meaning of error of transposition. But if that error of transposition affects one side of the account, the trial balance will reveal it. If the error of transposition affects both sides of entries, that is the debit and the credit, the trial balance will never reveal it. Because the trial balance deals with what? Balancing. So if your debit and your credit are both affected by the shortfall, the trial balance will not reveal it. That if it affects only one side of the account and leaves the other, the trial balance will expose you. So that is how these things work. So that's under correction of errors. And four, we look at adjustment to financial statement. And under adjustment to financial statement, we have accruals and prepayment. This area is very, very examinable. Last diet, they said they brought questions on it. So that is why this diet, I didn't leave it out. I taught it. Um, Depreciation, inventory valuation. If you have not looked at it, please, you have a chance to look at it today. Okay, so I'll explain something under IAS2 inventory valuation, because we have the FIFO and LIFO, which is also in intro to cost and management, and we have IAS2, which is a financial reporting standard, and it looks at the measurement of inventory. Every standard has certain criteria that you have to look at. You look at the measurement or recognition criteria. Okay, so we have the recognition criteria before you come to measurement. Measurement looks at basically two things: the initial measurement of the asset, or be it a liability or whatever, initial measurement. And we also have what we call subsequent measurement. So After initially measuring it, subsequently, how are you going to go about it? That's subsequent measurement. Then we also have disclosure. Disclosure. They are all in the manual. The manual stated four category of things that you see in every accounting standard. Four categories of things you see in an accounting standard. So you look at recognition, measurement, presentation, and what? Disclosure. These are the four category of things you see in every standard. Recognition, measurement, presentation, and what? Disclosure. It is in the manual. So as I said, everything I'll show you from the manual. I think this one is still loading. It will come. Everything I'll show you from the manual so that you know that the answer is there. Okay, so when it comes. So we look at IS2, okay, inventories, how inventory is supposed to be measured. Inventory is measured at the lower of cost and net realizable value. Okay, so the standard also defines what are the compositions of cost. So when you want to give a price to something or allocate a cost to a particular item, what do? You look at the purchase price. Is that not it? You look at the purchase price. You look at the what do you call it? The transportation cost. The transportation cost. And so far as it's an inventory to you are going to look at the storage cost because you are going to add it as part of your cost. Okay, you are going to include it as part of your pricing for the inventory when you want to sell it. Okay, you also look at um what we call conversion cost. Conversion cost includes all the fixed and variable costs. So both fixed and variable costs that you incurred in producing the inventory. Sometimes organizations do produce it, sometimes they buy it elsewhere. So you look at all those things. So the cost will is also include the cost of raw materials. Yes. So all these things comprises the cost. Then the net realizable value has a formula, and the formula is just estimated selling price of the inventory minus estimated cost to sell. Estimated selling price minus estimated cost to sell. Sometimes we also have estimated scrap value or something. Yes. So if that one too is also there, you less it. So we call it estimated disposal value or scrap value. So the whole formula is estimated selling price minus estimated cost to sell minus estimated scrap value or disposal value. That is the formula for the net realizable value. So if you see it in the examination, try and remind yourself of these things. Okay, we will see a question on that, so don't worry. There is a question here on IS2. Look at provision for doubtful debt, bad and doubtful debt. And in the manual, these two are different. You know, bad debt is different from doubtful debt. Are you aware of that? Are you aware that bad debt is different from doubtful debt? Hello?
Yes, sir.
Yeah. Are you aware that bad debt is different from doubtful debt?
Yes, sir.
So what's the difference, please?
O- A doubtful debt is still a debt that there's a chance of recovering it. But as for a bad debt, it has gone back, and there's no chance that you can recover such a debt.
Okay, so you are right. Okay, so the bad debt is irrecoverable. Okay, then the doubtful debt, the organization finds it difficult collecting the debt, but they believe and hope that they can recover it at some time period. Basically, what brings about the doubtful debt is that the customer that you trust a lot is now facing operational what difficulties. So most of the times it's customers that you have trust in them. They always pay on time. But this time around, what's happening is that they are facing some operational difficulties. That's what is delaying their payment. You see, when you go to every organization, they have some customers that they trust a lot. Customers who make prompt payment. So they have a list of customers like that. So those customers, they don't play with them. Are you getting it? So they normally even extend their credit policy for those customers, those special customers. We call them what special customers. So sometimes they will extend their period of payment so that they will be able to pay. So that's where the doubtful debt comes in. But the bad debt there, and no customer no stubborn on person. That's one. So you have to look at the conditions for bad and doubtful debt. So conditions for bad debt, that is where the debtor or the customer has gone bankrupt. That's one. Secondly, if he has traveled outside the country that you don't have any possible means to get him. That's the second one. The third one is if he's dead and no other person can replace him for the payment of the debt. Like his family members, they don't have those financial aid to pay the person's debt. You can't go and charge them because they are not owing you. It is the person who is dead that's owing you. So you can't worry the family members. So there are conditions, okay? There are conditions that will lead to this bad debt. Then with the doubtful debt, if, as I said, if the customer is facing operational difficulties or financial what constraints, then it will definitely lead to a doubtful debt. Now, these two have different treatment. You have to take note. These two, they have different treatment. So with a bad debt, initial recognition of a bad debt is to what? Debit bad debt account and credit, because bad debt is an expense. Why is bad debt an expense or a loss? The person was supposed to pay you, right? So in your books, initial books, a debtor, you record it as what? Receivables under current assets, because you have the belief that they will pay. Okay, they are your debtors. They are customers who are owing you. That's what we call debtors or receivables. So you have recorded it in your current asset as receivables. But you realize this percentage of people will not be able to pay. So that it becomes a loss to you. So that is an expense. So you have to debit that expense account, which is bad debt account, and go and take the figure out of the receivables figure in the current asset. So you credit what? Receivables. Because this is the idea. The whole idea is that the debtors who are owing you amounts to 5,000. Those who are owing you, it amounts to 5,000. Then you have noticed that 30% of this 5,000 will not be able to pay. It is irrecoverable. 30% will not be able to pay. So 30% of 5,000 is what?
Hello, sir.
Yes, please.
Please, we can't see the screen. Oh,
Is that so?
yes, please.
Okay, please, I'm coming. So all this while you were not seeing the screen. Is that so?
Yes, please.
Oh, no. So how is it now? Are you seeing it?
Yes,
I see
please.
my screen
Yes.
now.
Yeah.
Yes.
Okay, that's fine. So we are here. Okay, provision for bad and doubtful debt. So I was saying that 5,000 Ghana cedis is the receivables figure in your balance sheet or your statement of financial position. And you realize that 30% will be what? Irrecoverable. So 30% of this 5,000 will be how much?
1,005.
Good. So 1,005. It means that 1,500 will not be what? Recoverable. So what do you do? On a normal, what will you do? Would you go and take that 1,500 out of the 5,000?
Yes.
So that is why we what? We debit the bad debt. We debit the bad debt and we credit what? The receivables. That's the whole idea. Credit the receivables. So that's the treatment for bad debt. Debit bad debt expense account and credit what? Receivable. Meaning that you are going to take that figure out of the what? 5,000. When it comes to doubtful debt, as I said, the doubtful debt, you hope that you'll be able to what? Recover it. So what we do is that we make a provision for doubtful debt, or what we call allowance for what? Doubtful debt. We give them some allowance. We allow them. Okay. So that's what we call provision for doubtful debt. Okay. So you realize the debtor is going through somewhat distress. We call something financial distress or financial constraint. So he's finding issues with his finances. So he wants to what? Gain grounds. So you have to give him some allowance. Okay. Yeah.
So,
You have to
hello, sir.
allow. Yes, please.
So you debit the bad debt expense account with the 1,005, right?
Yes,
And then
please.
credit.
Credit
Okay.
the receivable. Yes, please.
Okay. Thank you.
You are welcome. So the doubtful debt, you allow the customer or the debtor some space so that he will gain grounds and come and pay you back. So you make a provision or you set some monies aside basically for this. That's what organizations do. They set monies aside basically for doubtful debt. They set monies aside basically for doubtful debt. So if the customer is not able to pay on time, they will use this money to what? Balance the account. Then when the customer gets the money to come and pay, they will refund that money into the provision account. That's what organization normally do. That's what they do. So when there is a doubtful debt, you debit what we call the doubtful debt account. So doubtful debt account. Then you credit the allowance for doubtful debt or provision for, it's also called provision for doubtful debt. So all provisions have a credit balance. So even if you forget, I said all provisions have credit balance. So you have to credit it. So you credit allowance for what? Doubtful debt. So allowance for DD, doubtful debt. Good. So that's what you do. So let's say the sometimes too. So this is initial recognition of a doubtful debt. Sometimes too, what happens is that the doubtful debt has already been what? Recognized. So in your trial balance, you see provision for doubtful debt, and there will be a figure there. You come to additional information where they will be telling you that another doubtful debt with the sum of let's say 600. So let me say the old provision for doubtful debt, the old doubtful debt was, let's say, 500. The old was 500. Then now the new, they are telling you the new is what? 600. The new is 600. So what do you think has happened? There has been what? An increase. Is that not it? From
Yes.
500 to 600, there has been an increase. So this is what we call increase in provision for what? Doubtful debt. Increase in provision for doubtful debt. Increase in provision for what? Doubtful debt. Increase in provision for doubtful debt. We call PFDD. Provision for doubtful debt. And now someone asks, so how do you treat that one? So an increase in provision for doubtful debt is treated as an expense in the profit or loss. Are you taking note of these things? Because it's very, very important. The objective in the so it's treated as an expense in statement of profit or loss. SOPL, statement of profit or loss. You have the acronyms. Wow. I like the acronyms. Good. So what do you think the decrease will be? So if the old provision for doubtful debt is 400, then the new is 300. What do you think? How do you think we will treat the decrease? Yes, who has an idea?
I think it will be an income because
Thank you. It will be an income. So this one, when you go to the statement of profit or loss, you record the difference. It's the difference that we need. So 100. That's the difference. And here to the same thing. Decrease. So the decrease is an income. Income. In SOPL, statement of profit or loss. So you record the difference, as I said. The difference is what you send there, 100. Now, these two, we have bad debt recovered and we have doubtful debt recovered. We have bad debt recovered and we have what? Doubtful debt recovered. So with bad debt recovered, what happens is that now you have recovered the bad debt. Bad debt recovered is an income. Okay, bad debt recovered is what? An income. So with bad debt recovered, what you do is that you debit cash because you are receiving the money. You have recovered it. So you debit cash and you credit what? Bad debt recovered account. Or possibly some others too do it like that. That bad debt you have recorded as an expense, now it is recovered. So why don't you offset it? So what they will do is that they will go and okay, so if you do, so you debit cash and you credit bad debt recovered. Yes, you debit cash and credit back because the money has now been recovered. So you are receiving the money. So you debit cash and you credit bad debt recovered. Please put it in mind. Put that in mind when there is a bad debt recovered. So that bad debt recovered will be treated as an income in statement of profit or loss. To be treated as an income because you are receiving the money. The one that they say is bad debt. Nipa no tu kwan ɔkɔ aburokyire no baeɛ no, akɔyɛ sika. Nti also obetua sika no ama. So bad debt recovery. And it does happen. And can't it happen?
It
It does.
happens.
Yeah, it happens. Okwa approach no one thing and can, so you thought it was a bad debt, right? Thought it was a bad debt. Now akwaba or the scaba into also betua sika no ama. So now that
Sir,
bad debt. Yes, please.
please, I want to find out something.
Okay.
Earlier on your submission, you said that when we are treating the bad debt, we should um, debit the um, bad debt expense
Expense
account
account.
and credit
Yes.
credit credit receivable.
Yes, please.
So now that we have recovered it and we
Yes,
are
please.
debiting cash, and you
Mm-hmm.
said we should credit
Bad debt recovered
a
account.
year.
Mm-hmm.
But first, is it not the name of the account? Is it not the same account that we have to go in, like the bad debt credit receivables that we have to debit
So,
or
so
differently?
the idea is that now you will not go and put it in receivables. Why are we saying that? Because that bad debt has now been recovered and has been paid in cash to you. You say, "Well,
Okay, so
bad
a
debt,
new
yes."
so a new account will be created.
Yes, yes,
Then what happens to the old one? You close it.
yes. The old one you've already closed it, so there nothing will happen to it.
Okay,
Mm-hmm.
thank you.
And the cash too is still an asset account, so it will not be affected.
Okay.
It will still balance. That's the whole idea. Um, I want to show you here. Good, 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 good. Mm-hmm. So here it is. Bad debt recovered. So on rare occasions, cash in respect of a bad debt, okay, a debt that has been written off as bad in previous year is subsequently received. It's on rare occasions because it doesn't normally happen. So you debit what cash and you credit what bad debt expense. But I would rather say bad debt because we have an account known as bad debt recovered account. So you rather credit bad debt recovered account, which is a separate account. But likewise, if you want to record it in bad debt expense account, no one will penalize you because you are offsetting it with the bad debt expense that you recorded at the debit. To answer the person who asked the question,
Yes, please.
mm-hmm.
It's clear.
So it's clear. Yeah. So you reduce the bad debt expense account, or you create a separate bad debt recovered account for it. It will still definitely go into the profit or loss and go and reduce the expense. It will go and reduce it because that one will be an income and the bad debt is an expense. So it will offset definitely. So accounting, that is why we always say that accounting is what? Subjective. Because no matter how the person will treat it, if it is in the right line, the entries, the debit and credit are correct. That's all. Yeah, befa. Mhm. So in the exams, if you see something like how bad debt be recovered, how do you treat bad debt recovered? And you see debit cash, credit bad debt expense. Don't be worried, it's the same thing. It's correct. If they
So,
if in the other way around they say debit cash, credit bad debt recovered account, that one too is correct. So anyway they bring it, you'll be able to what? Handle it. Uh-huh.
sir, can I
Yes,
ask
please.
this question? It might be a little off, but so
No
assuming
problem.
we are recovering a bad debt, but
Mm-hmm.
we take maybe the person's asset, as in maybe building, and
Mm-hmm.
we decide not to sell it, but maybe we want to use it for our company. I mean, we want to use it ourselves.
Okay,
Do
so
we
in that
treat?
sense, it means it's no more cash. They are not paying cash. They
Yes,
are
yes,
exchanging an asset to you. So you debit an
yes.
asset account.
Okay,
It happens.
okay.
So you are going to
Thank you.
debit the asset account and you credit the bad debt recovered or bad debt expense account to offset the debt.
Thank
And
you.
that asset that they are giving in exchange for that should sum to the same value as the bad debt.
Yes,
You
yes,
get my
please.
point?
Yes, please.
It should have the same value as the bad debt.
Thank you, sir.
You are welcome. So it wasn't off cry. So that is it. We are also going to look at partnership, partnership, theory and calculation because they bring it in the exams. Profit or loss appropriation account, partner's current and capital account, realization account, dissolution of a partner, and a new partner being introduced to the partnership. Yeah, we are going to look at it. So when we get a question, we go back into partnership, go and look at the things within partnership. So that is what I'm going to do. Okay, so when we get a question, we are looking at the question. I see that the answers are not coming as I expect. I'll go back into the topic, go and explain the things there. We come back to the question and you solve it. Is that okay?
Yes, please.
Yeah. And we will also be looking at accounting ratios. Accounting ratios. So I opened um, a document here where I've written all the ratios to be calculated, all their formulas. Nti mekyɛ mo some 10 marks or 20 marks here. Because ratios, it will cover at least 20 or 10 marks from there. So let's look at them. Okay, I'm starting from there. So under ratios, we have categories of ratios. Okay, we have categories of ratios. We have profitability ratio. Okay, the ratio that looks at the profitability sense of the business, the ratios that get to tell you that this business is profitable or not. That's the profitability ratio. We have liquidity ratio. That ratio will give you a foreknowledge as to whether the business is making cash or not. Okay, or has enough cash to be able to defray their debt when it occurs. So does the business have a lot of cash? Whenever we talk about liquidity in accounting, we are looking at cash, 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 cash. So under that ratio, we have two: current ratio, and we have what do you call it? Asset test ratio or quick ratio. We have efficiency ratio. Okay, so efficiency ratio looks at how efficient you run your day to day. Okay, because efficiency looks at your daily activities. How do you go about your day to day? And your day to day activities as a business, you'll be dealing with what? Vendors or suppliers. Is that not it? You'll be dealing with inventories. Is that not it? You also be dealing with what? Your customers. So these three things are under efficiency: payables, receivables, and what? Inventory. They are under efficiency. That will help run the business. Then four, we'll be looking at gearing or leverage ratio. That's debt. Okay, debt ratios. That's the gearing. If the company has a lot of what? Debt in its books, we will assess that. And the fifth one is investment ratios. Investment ratios. So I have done it like this: categories of ratios and the type of ratio under the category and the formula. You see, so this is very good. It will help you. So we have under profitability, we have gross profit margin. GPM is gross profit margin. In accounting, whenever we talk about margin, we are talking about sales. When we talk about margin, we are talking about what? Sales. So gross profit, sales. That's what they are trying to say. Gross profit, what? Sales. ratio. So gross profit margin is gross profit sales. Atasa. So the formula is gross profit over sales times 100. See how simple the formula is. But if you don't know, you see, that's where the problem is. If you don't know, that's where the problem is. We also have what we call net profit margin. So as I said, this ratios looks at what? Profitability. So net profit margin, that is net profit over sales times 100. Now, in financial accounting, we have financial accounting and financial reporting. We have three types of profit. We have profit before interest and tax, which we also call the EBIT, earnings before interest and tax. We have profit before tax, and we have profit after tax. So the student will be torn between which one to pick when they say net profit margin. But I am telling you that whenever they say net profit margin, use the net profit after tax. Are we following? Hello, are we there with me?
Yes, sir. Yes, sir.
Yes, please.
So whenever they say net profit margin, use the net profit after tax. Don't go and use any other profit. Use the what? Net profit after tax. Whenever they say net profit margin. Okay. Then we have the asset turnover ratio. Asset turnover ratio. So the asset turnover ratio is the revenue. That's your sales. Revenue is the same as sales. So your revenue divided by, so whenever they talk about turnover in accounting too, is sales. To get the formula, if you don't remember them, you can use clues to get the formula. So asset turnover, okay, your turnover is sales. So revenue divided by capital employed. Revenue divided by what? Capital employed. Where capital employed is equals to your total assets minus your current liabilities. Please put this in mind. Capital employed is equals to what? Your total assets minus your current liabilities. Are you okay with that? Hello?
So please come again.
So I'm saying that with the asset turnover, the formula is revenue divided by capital employed. And I said in accounting, whenever they talk about turnover, they are talking about sales or revenue. Sales or revenue. Okay. And asset here is rather referring to the capital employed, the asset utilization. That's capital employed. So revenue divided by capital employed. Okay. Where we say that the capital employed is calculated as the total asset. When we talk about total asset too in accounting, we are referring to the addition of the current asset and the what? Non-current asset. Are you aware of that? Total asset is the addition of the current asset and the non-current asset. Are you aware of that?
Yes, please.
So that current asset plus non-current asset, all minus what? Your current liabilities will give you capital employed. So that is what I was saying. This one should be at par with this so that you know that is the formula we are talking about. And let me pull this a bit down. Good, that's fine. So ROCE is what we call return on capital employed. Return on capital employed, ROCE. So normally ICAG, they don't want to write the full name, so they write ROCE. Good. So ROCE is calculated as EBIT, that's earnings before interest and tax. I think I've written it here. Or what we call operating profit divided by capital employed times 100. Now, we already have the formula for capital employed, which is total assets minus current liabilities. Now, someone asked me, how do you go about finding the EBIT? in your financial statement, if they give you a summary financial statement, what will tell you that this is the EBIT? So I'm showing you the EBIT, how it is being calculated. Good. So when you are giving the financial statement, it always starts with what? Revenue. Is that not it? Okay. So it starts with revenue coming. The way that thing has coming to. So we start with your revenue or your sales. We less cost of sales, right? When you less cost of sales, what do you get? Is it not gross profit? Uh-huh. So your gross profit, you less other expenses. So administrative expense, you less, selling and distribution expense, you less. Then if you have any financial income refers to investment incomes. You've gone to do an investment as a business. Do you know businesses, they invest their income? That's what they do. So if you invest your income as a business and you get a return on it, so that's the investment income. So that is this amount. Because it's an income, it will not be subtracted, it will have to be added. So when you add the investment income or the finance income to your gross profit less all expenses, you get what? The earnings before interest and tax, or the operating profit. So it is the profit that you haven't subtracted interest from. Because if you come down here, we less what? Finance cost or interest expense before we arrive at profit before tax. So that's why we call it EBIT. Profit before what? Interest and tax are going to be deducted. Profit before interest and tax will be deducted. That's EBIT. Immediately you deduct the interest expense from it or the finance cost from it, it becomes what? Profit before tax. When you deduct the tax, it becomes what? Profit after tax. Hello, have you caught the line? Have you caught the revelation? So that's why I told you we have three types of profit. So the EBIT is the what? Profit before interest and tax, or what we call the operating profit. Operating profit. So that is before you go and deduct interest, expense, and tax. That's the profit that you get. Immediately you deduct the interest expense or the finance cost from it, it becomes what? Profit before tax. When you deduct the tax, it becomes what? Profit after tax. So that's why I told you we have three categories of what? Profit. So we have profit before interest and tax, we have profit before tax, and we have what? Profit after tax. So that is where it is coming from. So now you know EBIT. You know EBIT. How you get EBIT. Good. So that is ROCE. ROCE is EBIT or operating profit divided by capital employed, where I said it is equals to total asset minus current liability times 100. So that is the formula. Now, okay, this one I think they've pushed it, so I have to push it up. I have to push it up a bit. Oh, probably I have to push this one down. Good. So we also have what we call operating profit margin. OPM, operating profit margin. So with operating profit margin, it is your operating profit or your EBIT. I told you EBIT is the same as what? Operating profit. So your EBIT or operating profit divided by what? Your sales times 100. I told you margin is sales. Margin is sales. Don't forget, margin is sales. Markup is what? Cost. Margin is what? Sales. Markup and margin, you remember. Good. So operating profit margin is equal to your operating profit or your EBIT divided by sales times 100. That's the formula. Are we okay with the profitability ratios? So you can take a picture, you can take a screenshot of it. So I'm doing this for a reason because we have ratio questions there to also answer. So if you are able to know, you are good to go. Liz, are you okay with this?
Yes, please.
Okay. So now we also have liquidity ratio. And I told you under that ratio, that's the simplest ratio you can ever calculate, liquidity. Because that one, it is only two. So we have current ratio and we have asset test ratio, or what we call quick ratio. So with the current ratio, as the name suggests, current asset over what? Current liability is to 1, or is to 1. And the benchmark we normally use is 1:1. So if it passes 1:1, it means it is good. If it is below 1:1, it is bad. That's the benchmark. Do you get my point? For every for the ratios that you calculate, with the profitability ratio, if it is high, it means it is good. So every ratio has a what? A benchmark. So they will give you the industry averages. Normally, they will give you the industry averages for you to compare, because the main reason why we calculate ratio is for what? Comparability sake. So what are you comparing with? It's either you are comparing over the years within your same company, or you are comparing with another competitor who is doing better than yourself. So in management accounting, when we come there, we call it what? Benchmarking. So you compare yourself with other competitors. That's what we call competitive benchmarking. So most of the times, what ICAG will do is that they pull the industry averages for you to be able to compare. Or they will not do it like that. They will tell you to compare over the years. Okay. So comparison is in two folds or two types. We have intra comparison and we have inter comparison. So intra is where you are comparing within your firm. So let's say you have divisions within your firm or sections within your firm that perform similar activities. So you are going to compare each of them, their what? Profitability status. Or you compare over the years, your performance over the years. That's what my organization like this we do. We compare over the years, how is our performance over the years. So that is what we do. So that is intra comparison. But inter comparison is where you compare with other similar firms outside your operations, other similar firms outside. So that is your competitors. Your competitors, you compare with them to know whether you are doing well or not. You get it? So that's good. Good. So liquidity ratio, as I said, so the current ratio, the benchmark is 1:1. If you get higher than 1:1, it means you are doing well. If it is lower than 1:1, you are not doing well. So the formula is current asset over current liability. The answer is to 1. Asset test ratio. The difference between the current ratio and the acid test ratio is that with the acid test ratio, the uh, the numerator, let me say like that. In mathematics, we say the numerator. So the numerator will be current assets minus inventory, minus closing inventory, to be specific, minus inventory, because the inventory we normally send to the balance sheet is the closing inventory. So minus closing inventory, all divided by what? Current liability is to 1. And that one, the benchmark is 2:1. So if you get higher than 2:1, you are doing well. Or you get exactly 2:1, you are doing well. Please, you get my point. You understand what I'm saying? Hello?
Yes, please. We
Yes,
understand.
please. We are okay.
Okay, okay. So we also have what we call efficiency ratio. And I was telling you about it, that the efficiency looks at the day-to-day running. So it looks at your what? Receivables, that's your debtors or your customers, the payables, your suppliers or your vendors, and the inventory. Okay, because these are the three main things that efficiency focuses on. And that is the three main things that keeps an organization running. So we have what we call trade receivables days. So the formula is trade receivables over credit sales times 365 days. Times 365, because a whole year is what? How many days? Is it not 365? So it's 365. When they say they want it in weeks, you multiply by 52 weeks. When they say they want it in months, what do? You multiply by what? 12 months. So that is how it works. When it comes to trade payables days, it is trade payables over credit purchases times 365 days. Now, with this one, there is a caveat, because sometimes you will not get the credit purchases you are looking for. So if there's no credit purchases in the question, you use cost of sales. Please note it down. If there's no credit purchases, you use what? Cost of sales. Please note it down. If there's no credit purchases, you use what? Cost of sales. Cost of sales. So that is where my emphasis is on. Inventory days. So inventory days is inventory divided by cost of sales times 365 days. Are we okay with this? This one is like a straightforward. We are okay
So
with the
please,
efficiency, right?
please, this one to the inventory days. Is there an instance that you may not have the cost of sales so that you use the credit purchases?
No, no, no. The cost of sales will always be given. That's the idea. That's the whole thing. The
So
cost
it's
of sales
only
will be
it's
given.
only at trade payables that you
Yes,
have those instances.
yes,
Okay.
please.
Okay.
You're welcome. So see, like this question, cost of sales is here, right? Cost of sales is here. Now let's come to the gearing ratio, the one I was talking about. The ratio that looks at what do you call it? Debt. Debt. So under gearing ratio or leverage ratio, we have basically two. We have the interest cover ratio and we have the debt to equity ratio. Wait, did I look at? So under the same efficiency tool, sometimes the question will come and they say calculate inventory turnover. They will tell you to calculate inventory what? Turnover. If they say inventory turnover days, they are referring to the days, the one we just calculated. Inventory turnover days is this one. Payables turnover days is this one. Trade receivables turnover days is this one. But if the question just says inventory turnover without adding days, the formula is going to change. It will be the upside down. So it's going to be cost of sales divided by inventory, but you will not multiply by any days. Please, you get my point.
Please come again.
Okay. So I'm saying that what ICAJ will do is that they will bring this in, they will say trade receivables turnover days. It is this formula. Trade payables turnover days. It is this same formula. Inventory turnover days is this formula. But immediately they change their mouth and say inventory turnover, the formula changes. When they say inventory turnover without adding this, the formula will change. So it will be the upside down. So the formula will be cost of sales over inventory. You will not multiply by any days, because they say inventory turnover. The inventory has turnover. So the cost of sales will come to the numerator side and the inventory will come down. If you like, you can just check this. Inventory days, is it not inventory over cost of sales times 365 days? But inventory turnover, it will change. It will switch up. So it will be cost of sales divided by what? Inventory. You will not multiply by any number of days. Please, let's take note of that. So this is inventory turnover, cost of sales over inventory. Trade payables turnover, it will be what? Credit purchases over what? Trade payables. If there's no credit purchases, what do? You bring cost of sales over trade payables. Do you get my point?
Yes, please.
So when they say inventory turnover, just without adding this, it will be cost of sales over inventory. But immediately they say inventory turnover days, then you go back to the one you already know. So this is the inventory turnover days. So it will be inventory over cost of sales times 365 days. Do you now get my point?
Yes, it's clear.
Okay. They like tricking students a lot with that thing. So the gearing ratio, we have two, basically two. So we have the interest cover ratio and we have the debt to equity. So the interest cover, when we talk about interest, we are looking at what? Interest expense, is that not it? So finance cost. In accounting, when we talk about finance cost, it's talking about interest expense. So the formula is your earnings before interest and tax, which is the EBIT or the operating profit, divided by finance cost. Your earnings before interest and tax divided by what? Finance cost. So how many times or what percentage of your EBIT contains the finance cost? That's what it means. What percentage of the EBIT contains or covers the finance cost? So what percentage of the profit do you use to pay the finance cost? That's the meaning of interest cover. What percentage of the profit do you use to cover your finance cost? So if it is higher, it means it's bad. So normally the answer is times. So how many times? How many times do you use your profit to cover your finance cost? So normally the answer will be something times. So the answer that you get will be to be equals to x times. So the answer times. So if you get 8, it means 8 times. I'm showing you all this because of a question. Because we'll be meeting a lot of questions today. Debt to equity, that's debt over equity, as they've already said, debt to equity. So debt over equity times 100. So that is the gearing ratio. And also so straightforward. Then the last one we have is what? The investment ratios. The investment ratio, they can tell you to calculate earnings per share, EPS, earnings per share. So that's earnings after tax and preference dividend divided by ordinary shares. Ordinary shares. So this one, they will give it to you. They will give you the variables you need and you use it to calculate it. So earnings per share is earnings after tax and preference dividend divided by ordinary shares. Dividend per share is what? Dividend divided by ordinary share. Have you seen it? Then we also have dividend payout ratio. dividend payout ratio. So it is equal to your dividend per share divided by earnings per share times 100. That's the formula for dividend payout ratio. Earnings, we also have earnings yield. Earnings yield is equal to earnings per share divided by the market price per share. Market price per share. Okay, as I've indicated here, earnings per share divided by market price per share. So that one too, they give it to you in the question. So here, with the investment ratio there, you shouldn't worry about how to calculate something. When you know the formula, they will just give you the figures, then you put it in the formula. Dividend yield is dividend per share divided what? By market price per share. Dividend cover, it is equal to profit after tax divided by what? Dividend. Dividend cover is equal to profit after tax divided by what? Dividend. We also have price earnings ratio. Price earnings ratio is equal to market price per share divided by earnings per share. Sometimes they will tell you to calculate the market price per share when price earnings ratio is given. So in that regard, it will be equal to earnings per share times price earnings ratio. That's you do cross multiply or change of subject or whatever they call it. So you do cross multiply. So it will be NPS is equals to earnings per share times PE ratio, was price earnings ratio. So I'm taking it again. I'm going through that one again because the investment ratios, there are many. So earnings per share is equal to earnings after tax and preference dividend, all divided by ordinary share. Ordinary share. So they will give you the number of ordinary shares and you divide it by the earnings after tax or the profit after tax and preference dividend. If there's no profit after tax and preference dividend, you just use the profit after tax and go your way. We have dividend per share. So that is your dividend divided by what? Your ordinary shares. The number of ordinary shares, as I'm saying. We also have dividend payout ratio. Dividend. So let me highlight the ratios we are calculating. So this one, this one, this one. So dividend payout ratio is dividend per share divided by earnings per share times 100. Then we also have earnings yield. Earnings yield is earnings per share divided by market price per share. That's earnings yield. Dividend yield. So as we say, earnings yield is earnings per share divided by market price per share. Then dividend yield will be what? Dividend per share divided by market price per share. So if you know one, you know the other. So whenever they talk about yield, it means you are dividing that particular thing by market price per share. This one too, they said dividend cover. So when they always say something cover, if you check the interest cover ratio, the interest rather came down. Have you seen it? The interest rather came down. So whenever they say something cover, that particular thing comes down, comes to the denominator side. So dividend cover is profit after tax divided by dividend. So the dividend came down. Price earnings ratio is market price per share divided by earnings per share. When you want to do change of subject and find the market price per share, it is equal to the earnings per share times PE ratio. So please let's take note of these formulas. Are we okay? Are we okay?
Yes, please.
Okay.
Please, I want to ask,
Yes,
can
please.
this be shared with
Yes,
us?
please. Let me share it. Let me
Maybe
share
in
it.
the chat box.
Yes,
Thank you.
you're welcome. Oh, okay. So the time we were not seeing the ball, someone had already sent a message from that end. Okay. I'm now seeing that. That's fine. Okay, it's running. So me too, if you leave me, I'll talk, sir. Okay, so Aya, when you are tired, you alert me so that we will break. Okay, so that's accounting ratios that we just looked at. We also have accounting for not profit making organization, where you look at statement of affairs to determine opening and closing accumulated fund. We have receipt and payment account, income and expenditure account, subscription account, subscription paid in advance and subscription in arrears, and treatment of donation, life membership, etc. So this other area is on and off, on and off. ICAG, that's what they do. It's on and off. So it's not highly examinable like that, but it's on and off. Ɛba betwam kakra na ɛkɔ saa. These two, the 7 and 8. So single entry and incomplete records too. So that is basically what the questions here will be bordering on. Let me see if it's downloading. Click to resend. Is it that big? Okay, I'm coming. Let me make it a PDF. I think that will help. Okay. So when it comes, so let's continue where we were. Okay. So
we are about starting with the questions. Okay, so let's get ready with that. Let me see if that's um I think I have to send it to you in the group. Because looking at, I don't know why I'm sending it in the main chat box. Okay, so let's start looking at the question. If it comes, then I'll just send it to you. So our first question we have here: financial accounting is mainly concerned with A, providing information for internal management only. B, recording, classifying, and summarizing financial transactions. C, preparing budget and forecast. D, auditing financial records.
I'll go for B.
You go for B.
B.
Okay, who else?
I'll go for B.
Okay, so we've gotten two people agitating for B. So yes, the answer is B. So when we talk about providing information for internal management only, we are looking at which one? Management accounting, MA. Okay, this aspect too is also MA. Preparing budget and forecast is also MA. Auditing financial records is also what? Audit. So I'll say AA, audit and assurance. So this one is what? FA. Good. The primary users of financial information are A, managers, B, employees, C, external users such as investors and creditors, and D, production supervisors.
I'll go for A, managers.
C.
C.
You go for A, managers.
C.
You go for C, external users such as
Yeah,
investors
yeah,
and
yeah.
creditors.
C.
Yeah, so that's the answer. Why did you go for A?
No, I was confusing it with the MA.
Oh, okay. Please be watchful about that when you are doing MA and FA. Okay. Uh, I say, oh, Debbie, we're FA. So my mind today is FA minded. I'm FA minded. Uh-huh. Otherwise, you confuse yourself. So, which of the following best defines accounting? A, the process of collecting money. B, the act of recording. classifying and summarizing financial transactions. C, the preparation of budgets only. And D, the calculation of profits.
B.
C.
Yes, yes. So that's the correct answer. Which of the following is not a function of financial accounting? A, recording transaction. B, preparing financial statements. C, assisting in internal decisions. D, communicating financial information to users.
C.
Yes, that's correct. Because C, assisting in internal decision making is MA. Management accounting does that. The basic accounting equation is Boboba. The basic accounting equation is A, asset plus liability is equals to capital. B, asset is equals to capital minus liability. C, asset is equals to liabilities plus capital. D, capital is equals to assets plus liabilities.
E.
C.
Eh?
C.
C.
Okay, so that's the correct answer. Uh, has the AE come, the document? Oh, still not. So,
No, please.
okay. Yeah, okay. I have my phone here. Let me send it.
I think you have to stop sharing the screen and then you share again.
That's why.
Okay.
Don't worry. I'm sharing it through the phone. I be they are all in the groups, right?
Yes, yes, sure.
Uh,
But you have to display your video so that those that they are not on the call can also have access to the video when they are watching it.
which one?
I mean the video. You have to share your screen, regardless of they having the questions or not. Yes, yes.
Mm-hmm.
They can see it now.
Yeah.
All right, all the best, all the best.
Okay. So let me send it here. Mm. I heard you are in the group.
The group, we have several pages, so some are on page 4.
Okay.
So I don't know how.
Some are on page 4.
Yes.
I'm in page 1, 2, and 3.
Okay, so
So I've sent it to page 1, 2, and 3.
So I will forward it to the page 4 as well.
Okay.
thank you, sir.
Okay, so which accounting concept requires transactions to be recorded separately from the owner's personal transactions? So let me bring your mind back to accounting concept. Okay, so with accounting concept, we said that they are the assumptions that we use in the preparation of financial statements. So the principles, the guidelines, the postulates, and the assumptions that we use in the preparation of the financial statement. And under assumption accounting concept 2, we have basically there are 11. There are 11. Okay, so I'm coming. As I said, everything we do, we have to make sure we back it with evidence here. So accounting concept. So we said accounting concepts and convention are the set of rules, principles, postulate, convention, and methods applied in measuring and recording business transactions and reporting financial information. Okay. So if we come, we have 4 fundamental concepts before the others will follow. So we have 4 fundamental concepts. So we have the going concern concept, or what we call continuity. So with the going concern, it assumes that a business will continue to be in normal operational existence for the foreseeable future. So a future that we can foresee. So the business has no intention of curtailing its operations significantly. So with the going concern concept, every business that is in operations should always prepare its financial statements with the idea that the business will continue for a very long time. Let me use this word, for an indefinite time period. You don't have any intention of ceasing your operations at all. Nti why a kiosk and now why a provision store, then you are planning to do the business for just 5 years and stop, then you are not a business minded person. That's what accounting is saying. Because what accounting is saying is that you shouldn't have a specified period of time that you say you are doing the business for, let's say, 15 years and you will stop. No. You should operate the business with the mindset that you are operating for a very long time, for which you yourself, you don't even know the time period that it will end. Till. That's what the going concern concept is saying. We also have prudence or conservatism. Prudence or what? Conservatism. This concept states that revenue and profits are not anticipated for, but are recognized in profit and loss only when, okay, only when it can be realized with reasonable certainty. So don't recognize revenue and profit in your books if you know that this thing, there's no reasonable certainty of getting it. Just like a typical example is grant. When government say you will give you grants, eh, and you have not received any documentation, it's just a mere say that the grant will come. You've not received any documentation, you've not received any letter regarding the grant. Are you going to be reasonably certain about the grant? I'm asking.
No.
Yeah, you are not going to be reasonably certain because you've not seen any documentation or any evidence backing the fact that the grant will be received. So as accountants, we don't want any problem. So we will not recognize it unless there is reasonable certainty that, oh, this grant, it will come. We have all the documentations available. We have everything in place that this grant, we will receive it. So that one, we can recognize it in our what? Profit or loss as what? A grant receivable. So revenue, income. So we know that we will receive it. But the other way around, when it comes to losses or liabilities, expenses and losses, we said we should always anticipate for them. So provision is also made for all what? Known liabilities. That's the expenses and losses. In other words, underestimate profit and what? Anticipate losses. It's not meaning that you should always make profit, you should always make losses and reduce profit. No. It's not saying that. It's saying that you shouldn't overestimate for profit and then buy. If it is coming and you are reasonably certain that it will come, then that one you can recognize it in your books. But if you don't have any reasonable certainty, don't go and recognize the revenue or the profit. Now, so nipa na ntua na ayɛ no den. But with the liabilities, always anticipate for it. the losses, always anticipate for it. Ko nipa nyɛ. It's highly possible that the losses there they will come. But with the profit, it is some 50-50 chances that it will happen. So that is what the prudence concept is saying. Prudence means certainty. You should always be certain about the revenue to be received before you recognize it in your books. But when it comes to losses or expenses, always make provision for them, because you should anticipate for them. They will come. They will come, definitely. So if the losses occur, if the losses don't occur, let me say it like this. If the losses don't occur and you've made a provision for the losses and they didn't occur, don't you gain?
Yes, you gain.
You gain. So that's what accounting is saying. But with the profit, if you make a provision that you receive the profit and the profit that doesn't come, what will happen? You will lose at the end. You will lose at the end. So that's why we are saying that with losses there, always make provision for them, so that if it doesn't even happen, you are on a safer side. If it happens, you are on a safer side. If it doesn't happen, you are on it. So that is what accounting is saying. We also have accrual or matching concepts. Accrual or matching concept. This concept states that revenue and expenses are accrued or recognized as they are earned or incurred. So revenue is earned, whilst income is what? Expenses is what? Incurred. Revenue or income is earned, whilst expenses is what? Incurred. So not when money is received or paid. So with this accrual concept, what it's trying to say is that we should recognize revenue and expenses as and when they take place, or as and when they are earned. For expenses they are incurred, not necessarily when money is what? Received for the income or paid for the expenses, because we are no more using the cash basis whereby you say that, oh, we should wait for the cash payment before we recognize it in our books. No, now it's not like that. We recognize the income and expenses as and when it takes place, and not necessarily when cash is received or paid for it. Do you get my point?
Yes, please.
Mm-hmm.
Pastor,
Yes,
please, can I
please.
ask a question?
Yes, please.
So, assuming this, there's a question under this, and concerning what you've just said, and they brought, or they bring accrual and matching. Which one of them should we take?
So I'm going to also tell you about the matching. So they did it accrual / matching. So the matching too has its own what? Explanation. So the matching says that we should match revenue earned against what? Expenses incurred in the profit or loss for the period to which they relate. So you see how it's different. It's different. So if they bring a question which is in line with the explanation that I gave for the former, then that one is accrual. If they bring a question which is saying that we should match revenue against what? Expenses for the period in which they relate, then that one is matching. You get my concept?
Oh, okay, okay.
You get my idea.
Okay, that's good. Thank you.
Yes, you are welcome.
Yeah.
Please, I hope the others too are getting it.
Yes, please.
Okay.
Yes, please.
Okay. We also have consistency or comparability concept. Consistency. So we should always be consistent, right? So consistency simply means that when you are doing an accounting treatment, okay, you should treat similar items in the period as the same. So this concept states that there should be consistency of accounting treatment of similar items within each accounting period and from one accounting period to another. So similar items should be accorded similar accounting treatment. That is what? Consistency. So if we have a group of assets in your books, and you say that one particular asset you are using what? Straight line basis. You can't do that. You have to apply the straight line basis of depreciation for all the assets in your books, because they are all what? Assets. That's the idea. If you are looking at inventory too and you are applying what do we call it? FIFO, you have to apply FIFO throughout. Okay. How consistent you apply an accounting method makes it a policy. So the consistent application of an accounting method or an accounting treatment becomes a policy of the organization. Because over the years, this is what we have been applying. You get my point?
Yes, please.
Yeah.
So that is the principle I always use at the workplace, because I look at earlier transactions, how they've been what? Treated, and do the same. Because if the auditors are going to check, the auditors are going to check it with earlier transactions, how they were treated, and tell you that no, this way you did it is not the right way. Maybe the new way would have been better than the old way, but because they have been using the previous method for a very long period of time, no, you would have to go by that. It has become what? A policy in the organization. Do you get my point?
Yes, please.
Yeah.
Yes, please. I thought you were asking a question. Okay. So that is the idea. So the consistent application of an accounting method becomes, over a long period of time, becomes a policy. Okay. So you go to some organization, they will say that, oh, our policy is that we apply straight line basis for all assets. Or our policy is that we apply reducing balance for all assets. Our policy is that with our inventory, we charge it using weighted average. Why? Because they have been doing that for a very long period of time. So they draft a policy document on financial statement and they put it there that this is the accounting policy. So that is it. That's the whole idea. So that is the four fundamental what? Concepts. And consistency will also help or aid comparability. Because consistency will bring about uniformity in financial reporting. So if you are using FIFO over the years, it means you can easily compare your financial statement over the years. Why? Because you are using FIFO over the years. So inventory for last year and inventory for this year can be compared. Comparability will only be possible when there is consistency. When there is no consistency, you can't compare. So the whole idea is that you can't compare apple with what? Oranges. How would that be possible? Because they should have similar features before you can be able to compare each other. Do you get the point? They should have some similarities before you can what? Compare. And that is what we are talking about when we are saying consistency has to go with what? Comparability, or comparability goes with what? Consistency. So these are the four fundamental. So if ICAG, in case ICAG asks you, what are the four fundamental accounting concepts? They are going concern, prudence concept, accrual or matching, and the last one, consistency. Those are the four fundamental. Aside the four fundamental, we have others. We have the business entity concept, which says that a business is an entity which is separate and distinct from its owner and from other units. So if you are an owner of a business, you should see your business as distinct from yourself. That is why we always charge drawings. We less drawings from the what? The capital. The whole idea is that you, the owner, should see your business as separate from you. Dama, you will be enjoying the little profit that you'll be making, and you will not be even able to tell that this is your true net profit at the end of the accounting period. But when you're able to separate your business from you, the owner, when you go and take Indomie from your provision store, you will recognize it as what? Drawings. And you know that, oh, my buffer Indomie, say. So if I had added that one up, my profit actually would have been this. Do you get my point?
Yeah.
So we should always separate the business from we the owners, so that we will be able to strike the balance and know our true net profit at the end of the year. If we
So,
don't
sir,
separate,
how do we, in this case, under this concept, how do we treat donations and gifts? Should that also be regarded as funds taken by the owner?
so if the donations and gifts in that regard are geared towards the business, it is for the business, it's not for you, the owner.
Oh, okay.
If the donations and gifts are just towards the expansion of the business, it is not for the owner, it is for the business. See it as for the business.
Okay, okay, sir. Thank you.
You are welcome. Money measurement concept. So with the money measurement concept, everything in accounting deals with money. So you can't do away with money when you are talking about accounting. That's why people see accountants as people who have money. Yes, so you need to be a obinisi can so we don't have money in our pockets. So money measurement concept in accounting deals with only items to which monetary value can be attributed. That's revenue, expenses, assets, liabilities, and capital, which are expressed in terms of what? Money. So we deal with if you bring something for us to pay, and we are not seeing money, we are seeing you've written a long statement, and there's no value, money value, we will send it back. But we don't need that. What we need is what? Money. When you attribute a figure, when we see the currency value, we see the currency sign, we know that yes, now you are talking. We can deal with it, we can handle it. But if there's no monetary value attributed to that particular thing, then we will tell you to send it to management accounting. We don't deal with that. Do you get my idea?
Yes, please.
So financial accounting, we are more concerned about monetary value. But management accounting, they look at both the monetary value and the theoretical aspect, or the quantitative, I would say the qualitative and quantitative aspect of financial information. But we, the financial accountant, we are concerned about only the quantitative. Materiality concept. In accounting, only items which are significant are given treatment in the books of accounts. So significant items, okay, items which are what? Significant, they have value. That is what we most at times recognize in our books. So information is material if its omission or misstatement could influence the economic decisions of users taken on the basis of financial statements. Materiality is a relative concept. It depends on the size of the entity. So that is what they are trying to say. They are trying to say that if you omit a figure from the books and that figure is not that significant, then it means it's not material. So what may be material to me might not be material to you. So in that regard, when it comes to business setting too, it's the same thing. If you go to a provision store, if the producer or the retailer, good, if the retailer sells and loses 50 Ghana cedis, share waboka papa hammer or beham. But when you come to a company like a gold mining company and they lose 50 Ghana cedis, now gold back will cry and they are losing 50 Ghana cedis, do you think they will complain? They will not, because 50 Ghana cedis is a chicken change to them. Or one gold cry what it cost, how much 150 Ghana cedis, so they will not complain. So that is why we are saying that materiality differs in respect to the what, the size and nature of the entity. So if you look at provision store, the size and nature of the entity cannot be compared with what, a mining company. You get my point? So when there is an omission or a misstatement of a figure and it can affect the economic decision of the user, then that particular item is material. So most of the times, the material nature items is what we treat as what, assets, the non-current asset. If it is immaterial, then we will normally treat it as what, expense, and write it off. So it is because of the materiality or significance of the figure, that is why some of these treatments are done. Because if you go to a printing press, stationaries, the one that we use in our what do we call our offices, those ones, they are going to treat it as what, their asset. Are you aware of that? The stationaries,
Yeah.
the erasers, pencils, they are going to treat it as their asset. But when it comes to we, the companies or the organization, we are going to treat it as our expense, or possibly we might treat it as what, inventories, because it is not really significant in our books like that, because we have big assets, we have gen sets, those things, right? So the printer that they will treat as their non-current asset, we might even treat it as inventory. So depending on the nature and size of the entity, that's where these things come up. So that is materiality concept. Duality concepts. Dual. When we say the word dual, it means two. So duality concept, for every transaction, there has to be two aspects, the giving and the receiving aspect. So that's why we always say debit the receiver, credit the what, the giver. Have you heard it before? Double entry.
Yeah.
Yes, please.
You've heard it before, right? So debit the receiver, credit the giver. So the duality concept talks about the what, the double entry. The double entry. We also have another concept known as revenue recognition or realization. It's similar to the what do we call it, the accrual concept, but just that here the focus is only on revenue. The accrual concept, the focus is both on revenue and expenses. So with the revenue recognition or realization, revenue is recognized, realized, or earned when goods are sold to the customer and not when money is received from the customer. So in another respect or in another book, they will say when goods are transferred to the customer. So immediately you transfer the goods to the customer, it's no more in your possession, it's in the customer's possession. So in that respect, revenue is recognized. So an example is, let's say you sold a spray to someone. Okay, you've given the spray to the person. Immediately you give the spray to the person is owing you. And yes, sir.
Yes, please.
So revenue has been earned. Not necessarily when the person has paid you cash. No. Now accounting is not like that. First we were using the cash basis, but now we say no. We are going by the accrual basis. So immediately you transfer that good to the the person is now in the possession of the good. We have cashed out. So revenue is what? Recognized. Mhm.
So if the
So not.
person returns it maybe a day after or two, say,
Mhm.
there's no condition to it. So the person maybe later realized that no, it doesn't need the goods again, and then he brings it back some few days later. How do we treat that? Then it means it's cancelled.
Yes, but I bet you if an organization is going by the revenue recognition, normally they will put a clause there. You remember there was a case whereby they said a soldier man had to go to a pharmacy shop and they beat the pharmacy shop. He beat the pharmacy attendant. Have you heard that case?
Well, for the
No,
purposes of this
Oh,
meeting,
you didn't hear? Oh,
maybe
it
you
came in
can
the
no.
news.
go over it again.
Oh, it came in the news and they interdicted the soldier man. Although, uh, as he has returned the drug and whatever, they have to give him back the money. But they had a credit policy that, so you should always read the credit policy of the company before you buy from them. Because they had a credit policy that the goods received are not what? Returnable or something. I
Returnable.
think. Now, what are free baby now? Want to return the good? I'll better there. No. You have to check all those things. Because if you send it home and it's faulty and you can't return it, then necessarily okay. And no customer would like to experience that. So you have to check out for all those things. So in that respect, oh no, we are recognizing revenue in that, and our barbarity on emfa emfa.
But in some companies, they will tell you that they will sell it, like they will sell it before they will reimburse you. So like what you brought,
Mm.
you have to give them some time to sell it. When you go to Abusoka and they like doing that,
Oh, okay. So other companies will rather sell it and give you back your money, right? So that
yeah.
one too is
So
there.
so it will take some time. So
It will take some time.
sometimes it can even take a month. And when you
Mm-hmm.
call them, they will tell you, "Oh, we've not sold it yet."
Yes, because it's very difficult because of this concept. It makes those things very difficult for the retailers, those selling. We are all managing. The accrual concept itself, it has its advantage and disadvantage. But I see that the cash one was just straightforward. You come and buy cash and carry. If you don't bring cash, we will not give it to you. You see. So with that one, it was fair. It was okay. It
Yeah.
was okay.
So, sir, I want to find
Mhm.
out too. So in this case again,
Mhm.
um if you are recording it, how do you treat it? Because here's the case that the person has returned the good and you said you are going to sell it and I mean disperse the funds to the person later, but you
Mhm.
recognize this as income in
Mhm.
your books, but
Yes.
the goods are with you. So if you are taking inventory, how do you treat that? The goods that have been returned, no? How do you treat it?
The goods that have been returned.
I know
So.
that.
Mhm. So
Yes. So what?
you sold it out to the person. So you recognized sale, right? Sales was
Okay.
credited.
Okay.
Sales was credited, and you debited your cash.
Okay.
Yeah, you debited your cash and you credited sales. But now you want to the person has returned it. So it's returned
Yes.
what? Inwards.
Yes.
It's returned inwards, which is you you debit return inwards and you credit cash
Okay.
because you pay him back.
Yes. But
Uh-huh.
not immediately.
not immediately. So you would have to
After
wait
use.
till the payment has been made. Or you most of the times what they will do is that they will put it at payables and
Okay.
liability. Uh-huh.
Okay.
So they'll put it at payables until it is paid, then you proceed to put it at cash.
Thank you.
You are welcome. Objectivity. Objectivity. So we said that even as part of the integrity, the principles or the code of ethics, objectivity. So financial information must be prepared and presented without any subjective what judgment or personal feelings. Don't do that. Present the information as it is. Don't do it based on your own personal feelings or based on someone's uh, subjective judgment. You will say that, oh, do it like this, and you go and do it like that. If the person is not a professional as you are, don't follow his advice. So there must be supportive documentation to every transaction in order to make them verifiable. I like this part. I like what they are saying. There must be what? Supportive documentation to every transaction. So every transaction would have to be backed by what? A source document. So source document is a document that gives evidence of business transaction. So you have um you've made a sale and you don't have any invoice, or you've made a purchases, you don't have any invoice backing that this purchases was made. Our place go and put they will reject it. Audit will reject it. Because you should have what? Source document backing the transaction that you want to make payment for. Because when auditors come, they will check. Oh, you say you've made this payment. Where is the source document backing? Where is the receipt? Where is the invoice backing this thing that you've made payment for? Then when I be say organization ho akyere no. So we have to always check out for those things. Source document, supporting documentation to every business transaction. So that's objectivity. That's what objectivity says. So that is the assumption or the concept we use when preparing financial statements. Okay. And we also prepare financial statements looking at time period, especially when you are doing depreciation. Depreciation. They will tell you the asset was bought 1st January 2012. They will tell you to calculate depreciation up to 2026. So you have to calculate, you see. So it's based on period. Whatever we do in the financial statement is based on period. When you are doing consolidated financial statement, that's in FR, you see that when there is a mid-year acquisition, you have to calculate based on the time period that they acquired the subsidiary, calculate up to the time they will report the financial statement. You see, it is based on what? Period of time or periodicity concept. So everything about the financial statement has to deal with what? Period. So period, we don't joke with it. When we are doing accounting, we don't joke with period. So sometimes you have to go and backdate. You have to look at when the asset was purchased. You have to look at when the invoice was there. When you see, you have to backdate. Sometimes you have to move forward a bit. Like everything is about period. So if you are not familiar with period, then you will not like accounting, especially depreciation. You will not even like it. You would have to be familiar with periods. Accruals and prepayment too has to come with periods. So they'll say rent payable for the year is this. Then they started paying it this time. You see, you have to calculate, count your hands sometimes. They say, 30 days has September, April, June, and November. All the rest are 31, except February alone. You see, you would have to count this when you know anything, but that is accounting for you. So sometimes you even forget that December has 31 days. So you have to try and also look at the periods. They are very, very important. Historical concepts. Historical concept states that the values of asset, liabilities, capital, revenue, and expenses are recorded in the books of accounts at their original cost, at which they were acquired and or what incurred. Okay, at their original cost. So the cost that you acquire the assets originally, that's what you recognize or you capitalize in your books. Do you get it? That's what you capitalize in your books. So when you are doing capitalization, you look at the cost at which the asset was bought originally, and that cost will include import duties, whatever. It will include all of them. To include professional fees when it's a building, surveyor's fee, whatever. It will include all of them. So that is the original cost of the asset. You capitalize that in your books. And you also state the date at which the asset was bought. So historical cost goes with what? Periodicity. The date at which the asset was bought. So that we can get the accurate depreciation for the asset. And we calculate depreciation as and when the asset is readily available for use. Don't forget that. Depreciation is calculated as and when the asset is readily available for use. So if you acquire the asset, let's say 1st January 2014, but you started using the asset in the middle of the year, that is 1st July or 1st June 2014. You start calculating depreciation from the 1st June or 1st July 2014. You don't start from when the asset was acquired, because the asset was acquired, but they needed some permutations or they had to do some legal then and sign, and the asset will be readily available for what? The use. So you don't start calculating depreciation immediately the asset is acquired. No, 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 we don't do that. We start when the asset is readily available for what? Use. That is when you start charging depreciation for the asset. Please, do we get it?
Yes, please.
Mhm.
But please, can I ask a question? Maybe this one too, it might be a little off. Let's take a car
Mhm.
vending company. So let's
Okay.
say I'm operating a car vending company, and we import brand new cars from
Okay.
yes, abroad, and we have them in our warehouse.
Okay.
So or in our garage. So um, let's say some of these cars we've
Mhm.
imported them a certain year, and then
Okay.
they've been with us for a certain number of years.
Mhm.
So um, because of the number of years it's been in our garage,
Mhm.
can't we depreciate the amount, and maybe when we are selling it out? So assuming maybe we bought it at a certain amount in about 5 years ago, but uh, looking at the current or how old it has been,
Mhm.
is it okay to depreciate it at a certain percentage and sell it at a lesser, or maybe you want to let it go quickly? Is it possible? I just want to know.
I like your question. So in that respect, you have to look at what classification of asset it is. So you deal in selling of cars. That one is not a non-current asset. So in that respect, we can't depreciate it. We only depreciate the non-current assets, which is the tangible non-current assets. That is
Oh,
the
okay.
ones we depreciate. And even land, we don't depreciate land. So land
Okay.
appreciates, we don't depreciate it. So that selling of cars that you do, it is in your normal operations to sell cars. That is what you do routinely. So the cars that will be in your warehouse will be treated as inventories. So the only thing you can do best for the consumers or the customers who come to buy the car is that you would have to revalue the car. You would have to what? Revalue the car for them. So the revaluation that you can do a downward revaluation for them so that they can buy it at a lower price.
Oh, okay.
So that one, it will not be what? Depreciation. It will rather be what? Revaluation.
So how do you treat that? Assuming maybe when I was buying it, maybe I
Mhm.
bought it 100 cedis, but then now I'm a downward revaluation has made it like maybe a 90 cedis. So how do I treat the difference?
So
Should I
that's
treat
good.
it as a cost to me or a loss to me or
So revaluation downward is a loss to you.
okay,
Is a
okay,
loss to you. So normally
okay.
what you do is that you debit the statement of profit or loss and you credit the asset account. So it's a loss to you. So you debiting the statement of profit or loss means that it is a loss or an expense. Then you credit the asset account, showing that it is a downward revaluation.
Thank you, sir.
You're welcome. So that's good. We are broadening our idea, our scope. Mhm. That's good. So substance over form. You also have substance over form. That's the last, and yes, I think so. Yeah, that's the last but one concept. So substance over form is saying that we should always acknowledge
Another
the
one. My
substance.
exam is on this one Wednesday. That's funny. And I don't know anything. So I have to go for this one, the intervention today. Because it is fun. Hey,
Uh, so
hey, sorry. Eh.
oh, don't worry. The substance over form.
That was head. This is my one going.
Okay. So the substance over form says that we should acknowledge the substance of an item or an asset or whatever it is over its legal form. So a typical example is a lease agreement. So with a lease agreement, the lessor, the lessor will hand over the property to you, the lessee, okay, or will lease the property to the lessee. So the lessor is the property owner, and the lessee is the one who is going to take the property in possession of the property. I get it. He's the one that they are renting the property to. So now, when he takes the full possession of the property or the assets, he has to recognize in his books that the asset belongs to him. So in the lessee's account, he will recognize right of use asset, showing that now he has the right, the full right and uh, ownership to the use of the asset. He can use the asset for anything he wants to. In accounting, whenever we say you have rights, it means you have control over the use of the assets. Right and control are the same in accounting. So you can use the assets in any means possible to generate some cash flows for you. So that is, it means you have control over the use of the asset or you have right over the assets. Good. You can use the asset for your own economic benefit to generate cash flow or whatever. So when the lessor hands over the property to the lessee or rent or lease the property to the lessee, now in the lessee's book, he will recognize that asset or that property as his own, as if he has possession of it now. So everything that has to do with the asset is supposed to be bared by him. So in accounting, that is how we see things. If the main owner has transferred possession to another person, that particular person that the asset has been transferred in his name is now the owner. That's how we see it in accounting. So in that person's book, we recognize it as an asset for that person, ignoring the legal form, which means the actual owner is there. We are not concerned about the legal form or the legal owner of the thing. We are concerned about who is now in possession of the particular asset. So that is substance over what? Legal form. You get it now? Hello?
Yes, sir, we are here. So
Uh-huh.
in this case, so like what you are saying, if I may understand, excuse me, let's say a company, a sole proprietor, and the owner is traveling, so has
Mm-hmm.
decided to hand over to the son.
Mm-hmm.
Um, yes, so but they have a, let's say, a credit facility. Um, yes, I mean the business to maybe has taken some capacity from the bank, and
Okay.
now something happens, and the company has gone bankrupt or something.
It's
Uh,
winding up.
do
Okay.
we now? Yes. So do we now go and hold the current owner per your explanation? Do
Per
we
my
even?
explanation, yes, in account, we will go and hold the person who is now in charge of the affairs of the company. We will hold him responsible,
Oh, okay.
not
Not
the
the
main owner.
original, the main owner. Okay.
Yes, not the
Thank,
main
thank,
owner.
thank you.
We will look at the substance over the legal form because it was as a result of your administration, your running of the affairs of the company that led to the company winding up. So we will hold you responsible and not the person who has left the country.
Oh,
That is
okay.
accounting. Yes,
Thank you.
you are welcome. Please, do we all understand the substance over form?
Yeah.
Mhm. The full disclosure. Full disclosure. So, in the preparation and presentation of financial statements, every necessary or relevant information should be disclosed. It should be what? Fully disclosed. Okay. So, what you are supposed to, the information that is relevant to the financial statement or to the entity would have to be disclosed to the shareholders. Okay. So sometimes we have the financial statement which is specifically geared towards the shareholders or the owners, is for the owners, and some of them which is public to the general public. Uh-huh. Because we have a way we prepare a report to the shareholders. So are you aware? We have a way we report to the shareholders, and we have a way we report to the general public. It shouldn't be the same because there are some information that we shouldn't lay out to the general public, or possibly we can prepare what we call a general. So that is why we have what we call general purpose financial statement, and we have specific purpose. So the specific purpose is normally geared towards a particular individual or the shareholders. Then the general purpose is for the whole everybody, whether bank, whether your customer, whether your supplier, whoever. So that's general purpose. It's tailored to meet the financial need of numerous users, but with a specific purpose is tailored to meet the need of one particular user. Please, you get my point? So the disclosure should be relative. You should know who you are disclosing the financial information to, because it's not everything you have to what disclose. Normally, we disclose about the figures which are being represented on the financial statement. That's what we disclose on. So we are seeing revenue. How did you arrive at the revenue? You have to tell us. You have to give us further information. So when it comes to the note to the account, you see how the revenue was calculated. So you see the right IFRS 15, then they disclose whatever went on in the computation of the what the revenue figure. Cost of sales, you come to note 2, they will show you how the cost of sales was arrived at. If you don't do that, then it means you are not being a good accountant. Full disclosure is very, very important. Disclosure is very, very important. You have to show us how you arrive at the figure so that we will be satisfied that okay, so this is how they did it. Okay, so they went by the what accounting standard. That's where we will be able to know whether you apply the standards well or not. So me, I always say that if I'm an auditor and I want to know whether you've done the right thing or not, I'll just go to your note to the account and go and look at how you apply the standards. If you apply the standards in the right way, then we will be satisfied. Or the way you apply the standard is going to tell what figure you are generating. The way you apply the standard is going to tell the figure you are what? Generating. So if the standard was applied rightly, then definitely the figure will not be wrong. That's how it works. Do you get my point?
Yeah, I think you are very right because I mean sometimes you'll be surprised when the financial accountants present to you that uh, the the expenses are equal to the income at the end of the day.
Mm-hmm.
Sometimes you don't really understand because
Yes.
without any, not even a peso or something on top, and like everything just knock out like that, how possible could it be?
Mm-hmm.
So it's good that you, I mean, you are telling us now. So you just go and then make sure that you ask for anything. I mean, everything that, uh,
Pertains to the income and
yes,
expenses.
yes,
Yes.
yes, yes,
Yeah.
so that you can do it yourself.
Mm-hmm. That's
Now,
true.
sometimes they will not give it to you when you ask them.
If they don't give it to you, that's where you have to know that there's something fishy.
"Hmm, it's not easy."
Mm-hmm.
Thank you.
You're welcome. So let's go back to our question. So now you've gotten to know all the concept. So now when you ask you any question about the concept, you know. That's how it goes. So that's how we are going to answer because the following questions we are going to answer are on the concept. So when they ask you any question about the concept, now you will know. So which accounting concept requires transactions to be recorded separately from the owner's personal transactions? A. Consistency concept. B. Prudence concept. C. Business entity concept. D. Accrual concept. So what's the answer?
I'll go for C, business entity concept.
It's right. It's right. So we said that the business entity says the business should be separate from its owners. Is that not it?
Yes, please.
Mhm. The concept which assumes that a business will continue operational in operational existence for the foreseeable future is called A. Matching concept. B. Going concern concept. C. Prudence concept. D. Consistency concept.
Going concern
Thank
concept.
you. You see how simple it has become. Yes. So if you know the concept, these questions will not be a difficult something for you. Financial accounting information should be A. Biased. B. Difficult to understand. C. Relevant and reliable. D. Confidential to management only.
C,
C.
relevant and reliable.
Yes. Does anyone have another answer? I'm not sure. I'm not sure. Which of the following is not a financial statement? A. Statement of financial position. B. Income statement. C. Cash flow statement. And D. Trial balance.
D, trial balance.
Yeah, trial balance is not a financial statement. Okay, let's take note of that. So this one is a financial statement. This one too is, and this one. Trial balance is not a financial statement. Question 10. The statement of financial position shows A. Income and expenses for a period. B. Cash inflow and outflow. C. Asset liabilities and equity at a specific date. And D. Profit or loss for the year. So what's the answer?
C.
C. You are
Yes.
right. So it shows asset, liabilities, and equity as a specific date. Who amongst us has not seen the statement of financial position before? Who hasn't seen some before? So that I'll just show it to you. I'm sure everybody has seen some before.
Maybe if for the benefit of the doubt, maybe you can just show it so
Okay,
that
okay,
should
that's
it be
fine.
available, you can just show it.
Okay. So this is a statement of profit or loss. Okay. So we start with revenue, you less cost of sales, gross profit, other income, you add them, then you less expenses and arrive at your net profit. So that's statement of profit or loss. And the statement of financial position is down here. I think that one comes before. Yeah, that one comes before this one. So here it is. So statement of financial position. So you have assets, you have equity and liability. Okay. At a specific period. So as at, you always say as at. Okay, as at. So as at means that the figures have been accumulated from January up to 31st December. So as at 31st December, what is left? Okay, so that's why they always say that the statement of financial position is as at. Okay, so as at 31st December 2029, what is left in your books? So that's why this statement is always as at. So we have assets and we have non-current asset and current asset. When you add, you get what? The total asset. So this is what I was talking about, total assets. Then we
Hello,
have
sir.
capital. Yes, please.
Please, regarding this, I know we are not in English class, but sometimes when they are writing, you see them saying as of. So is there a difference or
As
maybe a
of.
mistake?
I've
Yes.
not seen as of before. It
No,
is
not
as
on
at.
not really on the financial statement, but maybe when in their explanation or something, they will say something like that. I don't know, or it's a mistake.
It's a mistake. Go as of the
Okay,
is
thank you,
you're
thank you.
welcome. So we have capital here. We have non-current liabilities too here. Okay. So non-current liabilities are the loans that you go for, the long-term loans. Those are the non-current liabilities. And the current liabilities are the liabilities that you can easily settle within 1 year. The current assets are the assets that can be consumed within one accounting period. So that's why inventory, you can, within the period, you can even sell all your inventory. It does happen. It really happens. So you see that the inventory is zero. Well, you can sell all your inventory within a period. Do one accounting. So they are the assets which can be consumed within one accounting period. The
So,
current land. Mhm.
no, I wanted to ask something a little about what our brother, I think Mr. Godfrey also, who said about the as of.
As of because
I
I've
think
not heard it before. Mhm.
in grammatical context, maybe I've heard it before too in some books. But what I realized is that as of means that that's the beginning of that period. But
Okay.
when but what say is talking about as at means at that end.
At that
Ending
particular end, what is
so that's the
happening?
difference.
Yeah.
As of is the starting point. Like
The
if we say
starting.
as of
Okay.
January, that's from the January. But if you say as at 31st December, it at the ending of that time. I just
Mhm.
wanted to add a little to it.
Okay. Thank
Oh,
you.
okay, okay. Thank you very much, sir. Thank you.
So that's good. We are all learning.
Yes, please.
So we have capital. Another name for capital is what?
Equity,
Equity. Equity or
owner's contribution,
owner's what?
Contribution.
Or what is
capital
that part?
employed, or capital
No, no, no,
employed.
no. Capital employed is not capital. You remember the formula for capital employed? It is total asset minus current liability. Or you forgotten?
Yeah.
So what is another name for capital? Someone should say it for if you say it, Ghana will win.
Hey.
Is it
Another name for
equity?
capital. You said,
Equity.
yeah, someone has said equity. I've accepted that one. But there's one particular name that I know students don't pay particular attention to it. And what's that name?
Sir, please,
Okay,
is it net
Net
asset?
net asset, good. Ghana will win. So that's good. So the name is net asset. Net asset. The main reason why they call it net asset is because to arrive at capital, okay, it is your asset minus all your liabilities. So net simply means you are deducting something from that particular thing. So net asset means that you are subtracting all your liabilities from your what? Your assets. So that is why the other name for capital is net assets. So please, I beg, put this in your mind. So capital or equity or net assets. Okay, let's put that in mind. So this is how a statement of financial position generally looks like.
Thank you, sir.
You are welcome. The income statement is prepared to determine A, financial position, B, cash balance, C, profit or loss, D, total asset. I don't think this one you get it wrong. Anna.
Yeah, C.
So that's it. Which of the following is classified as a current asset? A, land. A, afa. Capital in a business represents A, amount owed to suppliers, B, owner's interest in a business, C, cash in hand, and D, total liabilities.
Is B.
Correct. So it's the owner's interest in the business. Okay. So another way they can ask this question is, which of the following represents the internal claims of the business? Internal claims on the business. So the owner's
Internal what?
internal claims on the business.
Okay, okay.
The owner's equity or the capital represents the internal claims of the business. Then the external claims will be that of the banks, the people that we give loans to, right? The people that give us loans, let me say it like that. The other institutions that give us loan, they are our external claims. They have external claims on our company. But the internal claims are the ones that the shareholders have within, because to form the asset of a business or to arrive at the resources of the business or what the business used to run its affairs, it is formed from two main components. That is the equity, what the owner will bring to the business, and what you go for outside the business, the debt or the loan. These are the two main things we use in running the business. It's either what? Equity or what? Debt. Or both. So we have organizations that are using both equity and debt. But do you know debt has more tax advantage than equity? Are you aware of that?
No,
Please
sir.
explain.
Are you aware of that?
Please clarify, please.
So interest expense is tax deductible per section 10 of the Income Tax Act 896. Are you aware of that?
No, sir.
We are knowing from today.
Oh, okay. You are not doing none of you is doing taxation, eh?
No.
Oh,
For me,
okay.
No,
no.
sir.
Oh, okay. Then you will definitely do principles of tax. These things will come to notice. So equity there, it doesn't really have much tax advantage as compared to interest. But the interest there's a caveat on it per section 31, 32 and 33 respectively, we have the safe harbor rule where it says debt to equity is 3:1. So we can't charge the interest expense for more than 3:1. So when you are doing the tax, you come to a notice of this thing. So don't worry, gradual. And after CA, you get to know a lot of things. You learn a lot. I'm telling you. So the accountant to your workplace, you will start arguing with him. You
So,
start
sir,
arguing.
please, can I ask this question again?
Yes,
You
please.
made mention of two sources of, let's say, capital for the
Habit
business. You
as
said,
sources of income to the business.
yeah.
Yeah.
So, I mean, either external or internal from the owner. So, I just want to find out,
Mhm.
uh, where do we place goodwill?
Goodwill.
Yes.
But will we say goodwill is a source of funding to the business?
So, well, I don't know, but I think it
So
can also be,
goodwill is an intangible asset.
yes.
Yeah.
So, can't that one also be used as a source of fund? Because if, yes, I have a goodwill, can't
Mhm.
somebody be willing to give me goods? Like, wouldn't it bring some kind of trust or something? Well, maybe you can explain it better. Maybe I don't
So
get what.
I get your point. So that one will come under the internal claim because it is the purchaser who is going to pay an extra amount because of the good name that or the good reputation that the business has, or due to the increase in market share of the company. So
Oh, okay.
most of the time it will come from the internal claim aspect, the owners, the
Oh, okay.
stakeholders. Yes,
Oh, okay.
because
Oh, okay.
the shareholders, sorry, shareholders, not stakeholders. When we talk about stakeholders from BMIS, you know that stakeholders comprises, it includes shareholders and all other people who have a stake or interest in a company.
Oh, okay.
Yeah,
Okay.
so
Because the reason why I'm asking this is that, assuming, let's say, Ghana, we are doing well, and in the world,
Mhm.
I mean, page, and let's
No,
say they recognize us as a good place for investment, and I have maybe, or I'm a son of a president, and I go out there, and I'm able to convince an investor that, okay,
Mhm.
if you give me this, I am coming to invest in the business here or something, because of I mean, the good report that they know, or
Mhm.
I mean, if they give me the thing, like whatever I need, I'm looking at it from that angle. I don't know whether I'm making sense with
So
the
yes,
submission.
so Ghana is going to benefit as a result of that. Are you getting it? So normally, what happens is that the investor will pay extra for that reputation or that good name. So that's where the goodwill comes in.
Okay, thank you very much, sir.
You are welcome. Which of the following example, which of the following is an example of a liability? So A, we have accounts receivable, B, cash at bank, C, accounts payable, and D, inventory. So
C,
what's the answer?
C,
You
C.
said? Thank you. So that's the
Answer
C.
answer.
is C.
The answer. Revenue in the income statement refers to A, money introduced by the owner, B, income earned from business activity, C, total asset of the business, and D, expenses incurred during the period.
B.
Yes. Afa papa, theory need there. Expenses are best described as A, assets used to generate income, B, liabilities owed by a business, C, costs incurred to earn revenue, and D, owner's drawings. What's the answer?
C.
Correct. Na make us afai. Theory legit. Drawings by the owner. Oh, A, increase capital, B, increase assets, C, reduce capital, and D, increase liability. What's the answer?
Reduce capital C.
Ah, my students are good. The cash flow statement reports A, profit for the year, B, assets and liability, C, cash movement during the period, and D,
Cash
owner.
movement.
Ah, which financial statement is prepared first? A, statement of financial position, B, income statement, C, cash flow statement,
A.
D. Here we will
A.
have different answers. Ah, I said it. Here we are going to have different answers.
B,
Guess
B.
what's the answer?
B.
Someone says
A.
A,
I
B.
also
B.
say B.
B.
B,
B. B. B.
B. You
B.
said B.
Yes, I said B.
You said B.
Yes.
Yes.
Okay, so someone says B, someone says A. Now, can you tell me why you said B?
Okay, I said B because you need when we are accounting for equity for the financial position,
Mm-hmm.
you need the equity, and you can only get equity.
You,
Equity comprises of the profit you make for the
profit.
year.
Exactly.
So,
Exactly.
Exactly. So that's good. So that is true. So that is why it starts with income statement. If you go and start with the statement of financial position, when you get to equity side, Obeka,
Wow.
Obeka. So you would have to come back and kind of do income statement. Income statement is the profactor of all the statement here, because you need profit when you are doing cash flow statement. You need profit when you are doing statement of changes in equity. So why will you go and start with statement of financial position? Udu Obeka. It will not be balanced and you will not understand why. Why? Because you didn't come and do income statement.
Afa papa.
I say, so that is it. So it's the income statement that you do first before the others will follow, before statement of financial position and the others. So if you check every company's annual report, they start with the income statement. Have you realized it?
Yeah.
If you check your and you will send the profit to the others. So let me show you something.
Hello,
Most of
sir.
the time,
We lost you at a point.
you lost me. Oh, now
Yeah,
I'm
we
here.
couldn't hear you.
Okay, now I'm here. So I want to show you something here. Well, PSC financial statement.
The papa.
At the end they say only my head. Only my head.
Emi apa 70 back no.
And the way you were also confident about it, no.
I see the way they will through the question.
The question is not about confidence. The question is about you sitting down and analyzing the question very well. Where we are going to meet a lot of tricky questions here. We are going to meet a lot of tricky questions.
They did the same thing in the law, like the last sitting.
Aha.
Through the question, they will give you tricky answers.
I see. Oh, let me see. I think it's even downloaded. It's part of my downloads. Well, filling station.
Hmm.
The Lord too, I have studied what do we call it? The company side, because they like bringing it.
Mm,
Mm-hmm.
that is what I'll be doing this evening. Please, if
Uh-huh.
you have access to some of the past questions, you can help me with them.
No problem.
Company side and then the contract.
The past question, the objective past question, I don't have some more.
Okay.
That one there, unless your law lecturer provides you with them, because he has those ones. I think the intervention questions, most of them were past questions, so most of
Mm.
them are part of the ICG questions.
Sometimes they will ask you question and they will say that like maybe they will bring some items
Mm-hmm.
and then they will say I this I
Yeah.
this
I
and then they will say A
That's
no
that's
they will
the
say A
ACCA style. That's
then
the,
they will tell
that's the
you
ACCA style.
one I
Really?
alone B I alone this sometimes it's
So many
very
important.
confusing.
It's very
And
stressful.
sometimes too they will bring and they will say one they will say A one
Mm-hmm.
uh then B only three C only four something like that. Like sometimes very trickish.
Mm. Don't mind them. ICG there. Or the thing, if they don't make it in that manner, you go and do the exam. You say, the ICG exams is not difficult. So it will also come out. People will be spreading. ICG exams is not difficult. We know what's the professional exams now. So it's like you get my point.
Yeah.
So it will be
but
like
but but it's not free. So definitely if it's difficult, it means that the student can also be discouraged because as you are not passing, you are also paying more. And then you'll be like, Charlie, let me go and do another professional course. Why? The BR me spend this casa.
yeah, it's true. It's true. We have
Can easily
people
be discouraged.
encountering that issue. Oh no.
Graduate.
Yes, please.
Please, what time are we breaking?
You are lying now. Hey, it's not for the week. I say it's not for.
Okay.
You are lying now.
I'm tired. I'm tired, sir.
You are tired. It's not easy.
Yes.
What I went through. It's not easy.
Maybe we can break at 12 and come back.
Yeah, yes. Because I also going to eat.
At times,
Because I see the questions are 100 and we've not reached anywhere yet.
Hey, how did you see that the questions are 100?
No, the
No,
questions
I
are
mean
88.
generally they said the questions are 100. So
yes,
I'm
the
talking
questions are
about the
100.
questions
You are
generally
saying
100.
that generally
Yes.
the ICAG questions. Oh no
Yeah.
no no. The intervention questions are more than 100.
Wow. So
Yes.
please let's try and exhaust all because I mean it's nice. I mean what you are doing for us is very nice. So my brothers, let's fight and stay. I mean,
I've seen it.
yeah.
I've seen what I was
But
looking
please,
for.
the one you sent to the group is 88 too.
Guess what?
The one you sent to the group is 88 questions.
It's how many questions?
88.
No. Then I'll send the rest. Sure, questions not awesome.
Yeah. Okay. Oh, please send all. Send all.
Hey, you all got to send more idea, and we're fully active, fully prepared.
Oh,
Seju,
yes.
Mpocho,
No, I'm not prepared. That's why.
Hey,
hey,
the way
Seju,
she's answering the questions, she's saying she's not prepared. I don't trust.
Was the
I'm prepared
calculation
only for
side?
theory. Yes, that calculation is there. No,
Okay.
they're known for
In
profits and partnership.
So I'm sending to the group. Okay.
SH, Obebu,
Oh. Oh, what if people are doing to SAG? It's no good.
Seju, then you'll be working and you are like, hey, I didn't go register cry then.
last one I'm trying, I'm in 48. Pa.
Okay.
That means you are good, though.
Which
That means you
But
are good.
yeah, I
You
got
have put the
46.
effort.
Also, I have 47, oh, I had 47.
I got 46.
Papa, anka miss ye.
So it's not me alone.
Oh, God.
Charlie. So
And
painful. Oh,
hey,
so painful. So painful.
this has been great. Yeah, we put on Basida. I think.
Have they come?
Yes, I've seen it.
Okay. So,
Okay,
see what
thank
I was
you.
saying. You see here, it starts with what? The income statement. The income
Yes,
statement is also known as the statement of
comprehensive.
comprehensive income. Yeah. So this is the name that they give to the company financial statement. They call it statement of comprehensive income. So you see, it starts with the income statement. They get the net profit. Where is it? The net profit after tax. Here it is. Okay, here it is. Then when you come to the balance sheet, or the consolidated statement of financial position, we have the equity side here.
Please, page 4. People don't have the rest of the question.
Page 4. Oh, I'm not in page 4. That's why. Is someone in page 3 and also in page 4? You can kindly forward it to them. I'm sure Rani is in page 4 and 3. Please forward it to them for me.
Page 3.
So there's no one in page 2 or page 3 who is also in page 4.
There's someone who forwarded the first one, so I don't know whether the person is still here or.
Oh, it's my boss. He did that.
Yes,
So let
I
me
mean the one who explained the question I asked first about the ASOF.
Okay. Then
think-
he's here. He's in the group.
Oh, okay.
He will send it.
Yeah, thank you.
You're welcome. We are thanking him in advance.
Yes, please.
Okay, so that is it. It starts with the income statement. Let's move on. Now we are on the financial statement because the questions which are popping up are on the financial statement. So financial statements are usually prepared at the end of A, each transaction, B, each day, C, accounting period, D.
C.
Thank
Accounting
you.
period.
The main purpose of note to the financial statement is to A, replace the statement of financial position.
B. Provide additional.
Oh,
Hey.
that's good. That's good. You see, I was mentioning the note. Development cost can be capitalized as an intangible asset only if. Do you know a development cost?
No, please.
Do you know where
No.
this topic is coming from?
No, please.
No.
We are it's coming from intangible assets. It's coming from intangible assets.
Oh, okay.
So let me show you. as I said, everything you show so that you refresh your mind on it or you remind yourself on it. If you've not learned it too and it's your first time, you grabs it or you pen it down. That's what I'm doing. So here's where it starts from. Good depreciation. So after the tangible asset depreciation, the next part is the amortization. Good. So here it is. Intangible assets. So intangible assets, instead of depreciation, we rather amortization.
We couldn't hear you.
You didn't hear me. I was saying that intangible asset, okay, with intangible asset, we don't call it depreciation, we call it amortization. So the depreciation of intangible asset is called, the name they've given to it is called what? Amortization. Have you taken note of it?
Yes, please.
Yeah.
Hello.
Hello. Hello. We can't hear you, sir. Sir Jude.
I think his network.
Oh, okay.
Hello.
And please, he'll be back. And I think the network, so he will be back.
I realized my network went off. I'm coming. Hello, please, can you hear me?
Yeah.
Yes, please.
Yeah.
Yes, you can.
Then I'm coming. Let me change my network.
Okay, so I'm back.
Welcome,
Can you hear
welcome
me
back,
now?
sir.
Thank you. Okay, so as I was speaking about the intangible assets, so intangible asset is an asset without a physical existence of substance from which benefit will be obtained over the long-term future. So like what you were saying, the goodwill. Goodwill is an example of an intangible asset. As a result of the long lasting nature of the company's reputation, okay, they are getting some benefits in the long run. I getting. So it doesn't have any physical existence or substance. Okay, so examples include patent rights, copyright, trademarks, and also cost of development. Okay, development costs. Development costs. So accounting for non-current intangible assets, because the intangible assets are what? Non-current. So under the non-current asset, we have the tangible non-current asset and the intangible non-current asset. So here we are looking at intangible non-current assets. So the accounting treatment for intangible assets is similar to accounting treatment of tangible non-current assets. That's the property, plant, and equipment. The asset is shown in the statement of financial position as a non-current asset, and intangible assets are shown separately from tangible non-current assets. So we don't add them, we separate them. So you see that they will write PP and they also write intangible assets, like what I was showing the well.
Mm.
We don't add them, we separate them. So the well, see, we have what? PPE, property, plant, and equipment, which is IAS 16. And we have what? Intangible assets, which is IAS 38. So we don't sum them, we separate them. Good. Until if a company sum them up, you can question them. So that one too, it applies straight line method of depreciation. The what do you call it? The intangible asset, the amortization is always straight line. We don't have anything like reducing balance. It's always straight line. So now let's
Yeah.
go to the development cost. You have a question?
No, no.
He was responding. Oh, okay. So let's go to the development cost. Now, before we come to the development cost, we have to know the difference between research and development. Because this one, they can ask you in the exam hall. The difference between research and development. Research is original and planned investigation undertaken with the prospect of gaining new scientific or technical knowledge and understanding. So it's a planned investigation that you undertake to what? Gain new scientific what? Knowledge or understanding about something. So, oh, I'm going to research about this. Oh, I'm going to research about that. So that is where it comes. That's where it comes from. But when it comes to development, you use the research findings to what? To generate a new product or to design something new. That is development. So you get the difference now. You get the difference now. Research, you are
Yes.
going to make an investigation uh, to get a new knowledge or to acquire a technical knowledge about something or understanding about something. That's why I say you are doing research. You are doing research. What can also I want to share definition of the research? So and then financial accounting is telling you the definition of research per IAS 38. But development is you applying the research findings to what? To develop or to design a new product or something, something new. That's the difference between research and development. So how do you account for research and development expenditure? Successful development work on a new product or techniques create value for the future. So in a form of higher revenues, lower operating costs, and higher profits. These benefits must be obtained over a period of many years in the future. So therefore, a successful development should not be treated as an operating expense in the year when the expenditure occurs. Instead, the expenses should be what? Spread over the years in the future when the benefits are expected to occur. So what we are saying is that if that development cost or development expenditure is for we are going to get benefit from it for a very long period of time, then we have to treat it as what? An asset, an intangible asset. We shouldn't what? Expenses. But if it is the benefit is for a short period of time, then we have to treat it what? As an expense. That is what the statement is saying. So IAS 38 includes the following requirements. Research costs must always be accounted for as an expense. Research cost, we have to always account for it as an expense. They are charged as an expense for the accounting period in which the expenditure is incurred. I get it. So we treat research cost as an expense. But when it comes to development cost, it has a caveat. So development costs are expensed unless the project satisfies certain criteria, in which case they must be capitalized and treated as what? An intangible non-current asset. So what are the criteria? The criteria is what they are asking us in this question. So we have to know them before we go and visit the question. So the criteria is one, that development cost should have the technical feasibility of completing the development work so that the item will be made available for commercial use or sale. Two, the intention to complete the item that is being developed and use it or sell it. Three, the ability of the company to use or sell the item. Four, how the intangible asset will probably generate future economic benefit for the business. Five, the availability of adequate technical resources, financial resources, and other resources to complete the development work. And the last one, six, that the cost of the development work for the intangible asset can be measured reliably. So these are the criteria that it has to meet before you capitalize that development cost or treat it as an intangible non-current asset. So I'm mentioning them again. One is the technical feasibility of completing the development work so that the item will be made available for commercial use or sale. Two, the intention to complete the item that is being developed. Yes, please.
Please, the point one, can you put it in a simple term?
Okay. So when we talk about technical feasibility, so do you have the technical guys on the field to be able to complete the development work? That's technical feasibility. So do you have the technical capability? So technical capability of completing the development work should be present. The intention to complete the development work for use or for sale. The ability of the company to use or sell the development item, the new product that you have developed. How the intangible asset will probably generate future economic benefit to the entity. The ability of adequate technical resources, financial resources, and other resources to complete the development work. And the last, so this one is more like the first point. The availability of technical resources is more like the first point. because the resources is also bordering on the feasibility, the capability. If you don't have the human resource, how will you be able to carry on the development work? So resources encapsulate the tools and equipment and also the human effort. They are all what? Resources. So that the cost of the development work can be what? Measured reliably. So if the first point is what is confusing you, it's just talking about technical proficiency or capability to do the development work. That's it. Are you clear about that one now? Hello, is it clear now?
Yes, clear.
Okay. So now let's go back to our question. A development cost can be capitalized as an intangible asset only if A, it is research related, B, the cost is low, C, management likes the project, D, the project is technically feasible and tends to be completed and sold or used. What's the answer?
D.
Nti wohu
D.
answer wei a yɛpɛ no ɛnti na yɛkɔɔ back na yɛkɔhwɛ criteria no. Answer wei a yɛpɛ no nti na yɛkɔɔ back kɔhwɛ criteria no nyinaa, so that you will know all the criteria. Sometimes or next time you see the question, maybe this criteria will not be there. There will be a different criteria which will be there. So how do you go about it? You get my point? That's why we went to look at all the criteria, so that when the question is being turned upside down, or you see a different item in the question or in the available options, you know which one to choose. You get my point?
Yes, please.
Yeah.
And thank
That
you
is
for
what
the
I'm doing.
approach. The approach is very nice.
Yes, you're welcome. So 23, if the opening inventory is $5 and closing inventory is $7, $5,000 and closing inventory is $7,000, and the cost of goods sold is $50,000, what were the purchases, or what would the purchases be? Do you know how to go about this? Do you know how to go about this? No problem. I'm not receiving any answer, so I know I'm far. So let's go.
Yeah.
Something like that.
Hey, so tell me, let's go. I'm ready. Give me the formula. How to go about this? Well, it's a format. So if you know the format inquired, you'll be able to do it.
I don't know if the formula is the right thing,
Oh,
but
so give it to me. You are trying. Give it to me.
I don't know if it's correct though.
Okay.
Like closing balance is equal to opening balance.
Closing balance.
Yes.
Okay, so this one, if you are
Mhm.
looking at this question, we are giving opening inventory, closing inventory,
Yeah.
cost of sales, then purchases. We are asked to find purchases. Now, my question will be, how do you calculate cost of sales
This.
or cost of goods sold?
Yes. Sir, I wanted to try it that way. We know that the
So
cost
how
of
do you calculate it?
the cost of goods is the
Opening
opening inventory plus the
minus
Okay, so
purchase.
I'm coming.
plus
I'm
purchases.
coming. Let's relax.
Okay.
So opening inventory, right?
Yes.
Yeah.
Yeah.
Hey, at the end of farmer mode, yeah. Hey. Opening inventory, okay. Then you
Plus
add what? You add what?
purchases. Net
Purchase.
purchases.
You add net purchases. Good. So we are saying net purchases because with the purchases you can have return outwards and those things in there. So that is why we are saying net purchases. Then you less what? You less closing inventory.
Less
Closing
closing stock.
inventory.
Yes.
Hey, Afa Papa.
I say, hey, Alpha. Well, you are not sure of yourself, eh? You should always be sure. So that's what will give you the what?
The cost
50,000.
Yes, cost of sales.
Opening stock at net purchases. So, Sir Jude,
Yes, please.
please, more times the net purchases do confuse me. Does it
Okay.
mean all other things with regards to the purchases has been added?
Yes, please. So let me give you the component of the net purchases too. So let me write them here. So net purchases computation, net purchases. So to calculate net purchases, it starts with the initial purchases figure. So your purchases. Okay, purchases figure. You add carriage inwards. And please take note, I said what? Carriage inwards. I didn't say carriage outwards. So carriage outwards is treated as an expense. So you add carriage inwards. Because carriage inwards is the cost you incur in delivering the goods or sending the goods to your warehouse. That's carriage inwards. Inwards. Good. And carriage outwards is the cost you incur in giving the goods to the final consumer. So they are two different things. So you add carriage inwards, you less return outwards or purchases returns. So immediately you less return outwards from the thing, you get the what you are looking for, your answer, net purchases. Have you seen it? So the question you were asking, this is the answer to it. So purchases, you start with purchases, add carriage inwards, you less the return outwards. So you've gone to make a purchase from a supplier, you brought it back, you found out that some of the goods are faulty, so you just return it back to the supplier. So that's what we call return outwards. Then get your net purchases. So we have opening inventory, you add net. So this is to calculate cost of sales. Okay, cost of sales. Good. So now let's put the figures there and you know what to do. You know that you have to do change of subject. So opening inventory was 5,000. Net purchases or the purchases figure we don't know. You name. Then closing inventory is what? 7K. So when we add all of them, we have to get what? 50, and this one is subtracted, oh please. We less closing inventory. So when we add all everything, we have to get 50K. So what will be the answer?
52,000.
Hey, will you get 2,000?
I said 52.
Okay. 52. So the answer is A. You see how simple it has been made here.
Hey, say you know.
Is it 52,000? Me, I'm not having calculator. You are the ones calculating it for me. So if you don't calculate it well, what's the answer? You can just do a change of subject. So 50,000, 50,000 minus 5,000 plus 7,000. What do you get?
I think it will be 48,000.
You get what? What do you get?
48,000.
48,000. No, BC 52,000. Hey, mbekumio.
So OP.
Hey, but I'm getting the 52,000.
Minus.
Oh, it's just see, do it like this.
It's 52.
It's 52. Do it like this. OP, like what
Straight line.
the
Yes,
senior
Do
man
it
is
again.
doing. Plus what?
Straight line.
P. Okay, that's the purchases. Minus what? CI
Mm-hmm.
is equals to
Cossack.
COS.
Mm-hmm.
So if you want to get P, it means that P is here equals to COS
Yes.
minus OE
Plus P.
plus
Plus
P.
CI.
Plus what? CI,
CI.
sorry. Yes. So that is change of subject where mathematics. Mathematics. So P will be equal to COS. What is the
50,000.
COS? 50K.
Yeah.
Minus OP is what?
Opening.
5K.
5,000.
52,000.
Plus CI is what? That's the closing inventory.
7K.
7K.
So when you add it, what do you get?
That's 52.
52,000. Yes, is it?
The nipa oka 52,000 then who song?
No, con.
Or no corner. So
Oh my goodness.
the 48K for how did you get it? I'm sure you added this one. That's why. If you add this one, then that one you get that. I'm sure they added this one.
Okay, so mine, I didn't do the change of subject.
Okay. What did you
Yeah.
do? Or another method that share with us.
I was just doing straightforward addition and subtraction.
Oh, okay. Hey, but I know so it will take time, Anna.
Like this one. When you add.
Oh, okay. Any way that works best for you, okay? Any way that works best for you, please use that one so that you get the right answer. My main focus is that you have to get the right answer. Yes, that's what I want you to do. So we are good to go, right?
Yeah.
Okay. Until 48 need a bit more. Until like 48. That is ICAG for you. The thing is that whatever you are thinking of calculating to get, no, or not the abesha amount. So if you calculate it and get it wrong, answer no. Hey God. So that's the sad thing about this thing. So the answer is there. So utiana no multiple choice So which of the following is a direct cost in manufacturing? So we make a crab. So let's remind ourselves. A. Factory rent. B. Raw materials. C. Supervisor salary. And D. Depreciation of factory plant. What's the answer?
Factory rent.
Is it A, factory rent?
No.
Direct cost. Direct cost.
Say, I'll go for raw materials.
I also go for raw materials. That's the answer. So he said direct costs. Okay, factory rent, they are what? Production overhead.
Indirect.
Production overhead, indirect. Okay.
Indirect.
This
Yeah.
one too is indirect. This one
Indirect.
is indirect.
Indirect.
So
Yeah.
this one is the direct one. Is that
I
okay?
think. Yeah.
Okay. You are not doing MA. MA for no manual headings. Okay. So if an accountant is pressured by a manager to overstate profit, they should A, comply to keep their job, B, resign immediately without saying anything, C, follow the entity's internal dispute resolution process and the code of ethics, C, post the entry and then tell the auditors later. What will you do?
See,
C.
C.
how do
But
you see?
you are telling me, see, if it happens your organization, won't you go for
B.
comply to keep your job? Huh?
Some of us will
For me,
even
I
take the
understand.
B.
For me, I
Practically,
understand.
practically
Hey,
A
hey,
is
yeah.
But
practically
for the
is A, but
but
I
for the
mean
Practically is A.
theoretically, yeah,
for
practically is
I
A,
don't know
but
who will go for the D. You are going to tell the auditors. No, don't do that. Hey, your boss will be in trouble. Don't do that. Cry. So practically we would have chosen A.
yeah.
And me practically cry, I will choose A.
Say what?
ICAG say follow the internal dispute resolution process and the code of ethics. And they think it's easy. It's not easy like that. In practice, it's not easy. Oh, am I lying? You tell me.
oh
No,
no,
it's
It's
so
you
very
practical.
true.
We
Very, very,
can't
very.
answer. Oh, we are doing the A cry. We are doing. Some of us are already doing it.
They're already doing the A. It's not easy like that. So that code
when
of ethics, it is in theory, but it's not in
one
practice.
time one time when the auditors were coming to our workplace, my boss went trying
Mhm.
and was telling us when they come in, they ask you this question, answer this way.
Say you don't know. Say you don't know.
Some of us
Uh,
he said
or you can probably say you don't work on that one.
yes, he
But
say,
You
but
know,
some of them said
Nina.
say this for me.
Mhm.
You have no option than to say it and save your job.
Oh yes.
So
Or you
can't
I
want
different
think
thing.
practically is mostly the opposite. Like you rather understate the profits because of tax issues and other things.
yes,
Uh,
yes,
they let you overstate the expenses.
yes, it's true.
Uh,
But sometimes too, they'll let you overstate profit so that the company will look good. Do you get my point?
yes, it's also there.
It's also there, yes.
Uh,
Mhm. So we have to follow that. Oh God. So do you know the 5 fundamental principles of ethics?
Yes.
What are
Yes.
they?
Integrity,
Mm-hmm.
Objectivity,
Mm-hmm. Obiambobi.
professional behavior, and
Professional
due,
competence and due care. So
Okay.
you've mentioned professional
duty.
behavior is 1 point. Okay. So you are
And
right. It's 1 point.
confidentiality.
Which one?
Confidentiality.
Confidentiality.
Yes.
Okay. Then professional competence and due care.
Yes.
Okay. So it's 5. Integrity, that's 1. Objectivity, that's 2. Professional competence and due care, that's 3. Confidentiality, that's 4. And the last one is professional behavior. Okay. So do you know the meaning of each of them?
Yes.
Yeah.
What's integrity? I like it this way in the town. So I like it when my students say they know. I'll start asking you questions. So what's integrity?
So, integrity means that the accountant shouldn't be biased in presentation of any information. There shouldn't
Okay.
be bias. Yes.
Is it that the accountant shouldn't be biased?
The accountant should be straightforward and honest.
Thank you. Thank you. I want that word, those words. There you know that you know because the ethical code of the ethical code of practice or code of ethics, we have it book. We have a book for it. So it's more like the standards. So we uphold it. So we have an assigned book for it. So that every accountant should have. So I have one here. It's a green book B. So you have to state it as it is. It's more like the standard. So always when ICAG examines, they want these keywords. If you were writing it as practical, they would have been looking for these keywords. And even in the objective, if you see this keyword, you know that it is this one, it is this one, it is that one. So that's why I'm particular about the key terms in your definition. So the accountant should be straightforward and honest in all professional and business related issues or business dealings. So the accountant should not conceal or hide any figures. Okay. So that's integrity. When it comes to objectivity, the accountant should not be subjected to the judgment of others. Okay. Yes. You shouldn't allow bias or undue influence to override his professional judgment. You should have a questioning mind. He should be what? Skeptical. We call something professional skepticism in audit. So the accountant should be skeptical. He should have a questioning mind to anything, every evidence that he gathers for his work. He has to be skeptical about it. You get my point. So that is objectivity. So even if you are a new accountant in a workplace and you don't understand certain things, just be skeptical about it. Don't assume that you know. Be skeptical about it and just go and ask, probe further to understand why they did it, like how they do it, so that you understand the processes. I expect most of the auditors to do this, but sometimes I don't know because some auditors they don't know how the business processes are done. Almost all mobile bisa question, then they are just auditing. Then they will issue some report. B. You see, it's not the best. Because the internal auditors, they know the processes within the organization already. So most of the time, we don't have issues with them. But the external, when they come, there are some way. Or they don't know the that is why in auditing we always say that we have to understand the entity and its what operations before we audit them. Okay,
But
so
say,
you
I want
come.
to ask something.
Mm-hmm,
Why is it that when the external auditors come,
mm-hmm.
they want the report, the internal audit report, and sometimes you realize that they come up with what the internal auditors find. They just go and verify those things, and then they pick the same things. Especially BOG like doing that a lot.
Sure.
Why do they do that?
Sir, audit is not easy like that, too. And mind you, the
But
internal auditors
somebody's
are
work.
on the
But
internal audit.
somebody's work.
Mm-hmm.
Somebody's work, you just go and verify. And
Yes,
maybe the
because
internal audit too, they are also following up.
the internal auditors also follow one thing. We have something in audit we call ISO, ISA, International Standards on Auditing, and ISA 610 and ISA 620. So ISA 610 is relying on the work of an internal auditor. So it's a standard that they are applying. So me, I don't have any problem with that. And that makes the audit very easy. So you just verify what the internal auditors have produced. And mind you, the internal auditors are employees of the company. So that is why there is a need to what? Verify their work. Make sure that whatever work they did was done independently
Oh, okay. So then,
and was done objectively. So it's ISA system which is guiding that act. So
So,
me,
but then
I don't have a problem with that.
but then how do they use that to like penalize the company? Because if you know that the internal auditors are working in isolation, it means that they are already checking or controlling that. So why then do you come and make it look as if it's your finding and you punish them for it.
So what
That's
what
why
what
I don't
happens is
understand.
that sometimes the internal auditors would find out the issues. Okay, so what the external auditor will do is that those issues that were raised by the internal auditors, did management take full concern of it? Did they act towards it? Because you know that the internal auditors, they test the internal controls a lot. So they test the processes, how work is being done, how things are being done on a daily basis. The internal auditors, they work on a daily basis. So they know the in and out of the company than the external auditors. So as an external auditor who doesn't really know much about the company, you would have to work with both the internal auditors and the audit committee of the company. So what happens is that most at times the internal auditors will raise this concern to management. Management will do nothing about it. So when the external auditors come, then they have a problem because that issue has still not been resolved by management. So that when it happens like that, they will still raise that concern. Unless that issue has been resolved by management, they will not raise it again.
Well, you are right. I mean, there's a practical issue that internal auditor raised an issue, and management was not taking it serious. They were
Yes.
making light of it. When
Mhm.
POT came, raised the same issue. Now you see the big men running here and there. I
You
mean,
see.
going task at task, just trying to resolve the issue.
Yes,
Meanwhile, the
they think
same
the
issue.
internal auditors, or they are the employees of the firm, like we are so oh can they now like that kind of thing. So they would not take them serious. But immediately external come, the issue becomes something else. Because in the government sector, anything that the external auditor will take up is going to what do we call it? Public accounts committee. Is going to Parliament straight, Public Account Committee. Especially when the audit service, the Ghana Audit Service people come and audit you. We see them as external auditors. Immediately they come and audit you and they find something, it's going straight to the Public Account Committee. So in order not to escalate the matter, na acquire say bribe na their BAME, that kind of thing. But it's better when the internal people see it, you resolve the issue so that there will be no problem. Because most of the times they will rely on the work of the internal. Why? Because the internal are the people who are working on a daily basis. Company. Like if you are saying the head to toe of the company, the internal people, they know everything. They know everything. Even the thing that an internal auditor will know, we the finance department people might not know. Because they know everything about the company.
So I want to ask something. This
Yeah.
one might be out, but just for personal way. Is it also good, ethically good, to, as an internal auditor, to hide some information from the external auditors? If
that's not good. That's not good. You are even putting the company at a risk.
No. Yes. What I mean is you know, like maybe internally you've also given the information to management that they are working on it. But then you know that if you disclose this to the external auditor, it will put the company to more.
I get your point. I get your point.
Is it ethically good to hide it in a
That's
certain way?
also an ethical dilemma. That's also another ethical dilemma that we are facing. Yes, it's true. It's because it's still borders on the fact of confidentiality. But auditors, when it comes to auditors, because with auditors, confidentiality doesn't apply to them.
Yeah. So I think I want to say something small.
Okay.
I appreciate the class, your way of teaching, and even my friends and brothers, their questions. They are opening our eyes, not just to the exams at hand, but also to know practically some of these things we encounter. So I
Yes.
just want to use that opportunity to introduce myself more. Actually, I'm not sitting for this July, and I've not
Okay.
done accounting so far. So if some of my answers are awkward, kindly forgive me. I just started learning the accounting and law so that the next sitting I can also join. But
No problem.
what inspired me most about the discussion is the topic my friend Xavier has entered, because I actually work with some auditors, let me say private auditors as a secretary. And
Mm-hmm.
it is the work that motivated me to also at least know what I'm doing. You can't just say you are a secretary, so you don't know the kind of work. And all these things,
Mm-hmm.
surprisingly, that you are just discussing and the way you are answering to them are things that have happened and I've experienced them. And I don't know, because of confidentiality reasons, we can't mention them, but
Yeah, it's true.
that's just exactly how some were handled. And so I want to let Xavier know that he's not wrong, because there are certain instances you shouldn't go just accordingly, like because of this hiding some information. You can't just pick into to what the internal auditor has put forth there, because they may hide certain things. But there are certain circumstances. My boss always say that as far as he's an auditor, he goes by the ethics and the standards. You can't just go to the area he has gone to. Exactly.
Yes. Yes.
Yeah, but I once said to help me, because there's an issue where some auditors, let's say it's an NGO, we
Mm-hmm.
audit the projects of that particular NGO.
Okay.
Then the main accounts for the, how do you call, the secretariat, like the whole company, the
Mm-hmm.
NGO rather, is being handled by another auditor, not
Okay.
internal auditors. I'm talking about other external auditors.
Yes.
Then when we go to verify the vouchers for the projects, the accountant gave us, the finance officer just gave us the voucher and said, oh, this has already been verified by the main auditor when he came for the main work. So there's no need wasting your time in verifying them again. So when our audit staff reported to the office, my boss said, no, the fact that they verified does not mean we can solely rely on them, because
Yes.
the project. So that's why I'm saying that I appreciate the way you are handling it and the way you are also giving flexibility to it. Sometimes circumstances compel you. Sometimes time and other things may
Mm.
go. But the proper thing is sometimes you don't rely solely, because we are in Ghana. So I just wanted to add, and I appreciate. So I hope that I'm learning a lot as we move forward, and I just pray that time will be on our side, and then we will cover a lot. I've already started reading the books, and for now I'm getting it. I don't know how far we'll go, and things will become complicated for me. So
Oh,
thank you very
it's a
much.
lot. You understand it. You appreciate the CA journey, because audit is very, very interesting. When you get to level 2, you do audit and assurance. You also do advanced audit and assurance in level 3. So I have done both audit and assurance and advanced audit and assurance. And I've also actually done audit with JRE tax audit. So I know the issues on grounds and what.
Yes,
Yes. So
your
you
answers are
have,
nearly asked. I wanted to say, you speak like an auditor, but so you have the
Sir
experience.
Jude. Sir Jude.
yes, please. Any
Oh,
any question? You have a question?
no.
Oh, okay. You are hyping me, hype man. I see. Okay, that's fine.
Sir Jude, after the program, you have to give us your number.
Okay, okay, no problem. Okay. So the principle of confidentiality means an accountant should A. Never disclose information under any circumstances. B. Sell client data to competitors. C. Share client information with friends. D. Not disclose information unless there is a legal or professional right or duty to do so.
That's D.
Yes, that's the right answer. I remember I had a discussion with some students and they chose A. Never disclose information. No, 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 no. That shouldn't be the point. That shouldn't be the point. Okay, there should be a circumstance that you can disclose. there should be a circumstance that you can disclose, because auditors like this, as I said, we have to disclose certain things. Okay, an issue with regards to money laundering has to be what reported to the money laundering reporting officer. Okay, an issue of what do we call it, fraud, it has to be reported to the necessary authorities. Like, there are channels for you to do the reporting. Okay, so you inform management. If management is not doing anything about it, then you go further and you escalate the matter. So that is it. Because auditors, in audit, we always say that the audit you are doing should be in the interest of the shareholders and the public, the general public. So it shouldn't be to your own interests, because your own interest will be like you are collecting pay from them, or you are receiving your fee, your professional fees from the company. So you would like to do everything in the best interest of the company or something. But no, whatever you are doing it in the best interest of the what? The shareholders, who are the owners, and also in the interest of what? The general public. Because the general public will actually place a reliance on your audit report. There's no doubt about that. They will place a reliance on your audit report. So whatever you are presenting out there should be the right thing. So that is why you would have to disclose certain issues in the interest of the what? General public. Do you get my point?
Yes, please.
Okay. A business has a markup of 25%. This is equivalent to a gross profit margin of A, 20%, B, 33.3%, C, 25%, and D, 50%. So this one,
33.3%.
okay, so we are going to do the computation and see if that is true. Okay. So this one, markup is calculated on what? Cost. Are you aware of that?
Yeah, you
Markup,
said it. You said it
markup
even
is
earlier on.
calculated on cost, and margin is calculated on sales.
Yeah,
Okay.
you said it this morning.
So if you want to be sure of whatever you are doing, you can just simply do it. The markup is 25%. Is that not it?
So that'll be 25 over 100, right?
The markup is calculated on cost. Did you get my point? So 25 over 100. That's good. You're right. So we have to get the margin. So how do you get the margin? So that is 25 over 100 plus 25. That's how you get margin. That's how you get margin. It is 25 over 100 plus 25. So when you are changing from markup to margin, you add the what? The numerator to the denominator. When you are changing from margin to markup, you subtract the numerator from the denominator. I'm repeating
Can you
that.
go over again?
Wow. Wow. Thank you.
So when you are changing from markup to margin, okay, markup to margin, you add the numerator, because margin is always higher than markup. So you are going to add the numerator to the what? Denominator.
Sir Jude, I'm proposing that when we are going for break, we have to take you for lunch.
Oh.
I'm proposing to that.
Oh. Don't worry.
Guys, don't you think so?
We think so.
So markup to margin. So we always say that markup to margin, you add. Margin to markup, you subtract. That's the saying. So we will add the what? The numerator to the denominator. So what do we get? So 25 over 125. That'll be what? Or some people too also do it like this. They will just do it 25 will cancel itself 1 and go into 100 4 times. So they will do it 1 over 4. So when they are changing it to margin, they will just do it 1 over 5. So that's 1 over 4 plus 1, which is what? Exactly equals to 1 over 5. So 1 over 5 times what? 100. What do we get? So 5 will cancel itself 1 and go into 100 how many times? 20, right? So the answer is what? 20%. So I heard someone say 33.3%.
Yes, please.
How did you get that one?
I can't explain.
Okay. So the answer is 20%. Okay. So from markup to margin, you add.
Confidential.
Please, he said.
He said he can't call it confidentiality.
Oh, okay, I see. So that's confidential. Okay. So the, do you have a question?
I have a question. Yes.
Okay.
I don't know if I heard rightly. You mentioned something like the margin is usually higher than the markups, right?
Yes, please.
But this one, when we change markup to margin,
You
we
add.
are rather getting a lower percentage amount.
Okay.
Or
So thank you for that. So when we say that the margin is higher than the markup, you see, most of the times the margin is calculated on sales, which means that sales is higher than cost.
yes,
Yeah, that is the
always.
idea, but not in terms of the percentage. Not in
Okay.
terms of the percentage, yeah.
So that one has to do with what is being calculated on physically.
Yes, please. Yeah.
Okay, sure. Thank you.
You are welcome. Is there another question? Oh, you are okay.
Yes, please. I'm okay. I'm okay. Like so, usually, like what you explain. Yes, I get it. Thank you.
You are welcome. We have another calculation here. So from here going the calculations on, if opening capital is 100,000 is $10,000, closing capital is $15,000, and drawings are $2,000. What is the profit? What is the profit? Do you know the formula for this one too? Because the other one, the cost of sales, you had the formula. So this one too, do you know the formula?
Why you
Miss Rainey, do you have the formula?
You know it? No,
The answer is A.
All right.
Hey.
No, I'll go for B.
Someone has just given us the answer. But how did you calculate it? That's the main thing. How do you go about it? Okay, so that you'll be sure that the answer you are getting is the right answer. That's where my focus is. How did you calculate it? Okay, so let's look at the format.
Okay.
So we start with opening capital. Opening capital. So the initial format is what I'm writing. Opening capital. If there is any additional capital to you add it. Okay, you add additional capital. So after I'll show you where in the manual this thing is. So you add any additional capital to it. Then you less drawings. Thank you. You less drawings. I'm coming. I didn't bring the profit, so let me bring the profit precon. So you add profit too. So I'll normally say profit if any, because sometimes it can be a loss. So if it is loss, you subtract. So you add. Then when it's a loss, I'll put it in bracket. Then we are going to less the drawings. Good. So that's where you arrive at your what? Closing capital. This is what we normally do in the balance sheet. Good. So now we have been given the figures. So we are just going to place them in the formula. So we have opening capital to be $10, 10,000. Additional capital we don't have. Okay, so it's nil, 0. Profit. Profit too, we don't know it. So we put a question mark there. Drawings. What was the drawings? 2,000. So we put it in bracket, you less. Then what was the closing capital? That's 15,000. So it's just like the other one, change of subject. So what will be the formula? The change of subject. When you want to make profit the subject. What will be the formula?
It will be P equals CC minus 0.
So P equals CC.
P profit CC minus OC
plus D, right?
D, yeah.
Yes. You are correct. So CC is 15,000 or 15K.
Hello, Jude. Can
Yes,
you hear me?
Yes.
Kindly check WhatsApp. Check WhatsApp.
Okay. Plus the D is 2K. Okay. So what do we get as profit?
7,000.
7,000.
Yes.
Hey, so the person who says 7,000, Afa.
Yeah, so
No.
I was about to give me my short formula, what works for me. So instead of now going through this whole thing, my formulas I usually work with either drawings or profits. It's usually profit is equal to closing capital minus opening capital plus drawings.
Yes.
Okay.
That's what I move with it, and I'm done. Done going through all this. So yeah.
Please, can you repeat it?
You are right. You are right. But then what he did is very important because it helps us to, especially when you want to know when we haven't read the maybe statement of affairs and those things. This one will help. But
Yes.
the formula used, my sister, no, that's the same way I also use. If it is capital introduced to, I just subtract it instead of adding. If it is drawing,
Yeah.
you add. If it is capital introduced, you subtract. I think that's what I will normally use when it is objectives.
Yeah.
But if it is calculation, what said it will help us to understand.
Yes, yes.
Okay. So the answer is 7,000. The person who says 7,000, then who song. Okay, so let's go to 29. Subscriptions received in advance are treated as. I like that.
Current liabilities.
Current liabilities.
Hey, Afo. So
Indeed.
that's the idea.
It's a Jude.
I have an acronym for identifying these things. Okay. My students will even tell you. We have an acronym for identifying these things easily. So we have AICA. Okay. We have,
AICA.
yes, we have PICA. I'll explain. Don't worry. We have PICA. We have AECI, right? CL. AECL. Then the last one is so AICA is accrued income current asset. Accrued income is a current asset. Okay. Note that for the not-for-profit making, subscription received is an income to them. So when you establish that, that's one way of answering the question. And they say in advance. In advance is prepaid.
Jude, please, your network was a bit breaking at my end, so if you
Okay,
can take
so
it again.
I'm stating whatever I said again. So to a not-for-profit making organization, subscriptions received is an income.
Yeah.
Okay. I think the last I was telling my student that subscription to a not-for-profit is an income. Then in advance means prepaid. You have paid in advance. It's prepaid. Okay. So this one, AICA, is accrued income. It's a current asset. Accrued income, current asset. This is prepaid expense, current asset. And here is accrued expense, current liability, prepaid income, current liability. So here falls under which category? Is it not this?
Yes.
PICL. So prepaid income is a current liability. So your answer is what? Correct. So that is what I use when it comes to accruals and prepayment. I have these acronyms there so that in the exam hall, I remember accrued income. Okay, income that is owings. Okay, accrued income is a current asset because it will be receivable. That is why it is a current asset. Okay, accrued income. That is income that someone is owing you or revenue that someone is owing you. So it's revenue receivable. It's a current asset. Then prepaid expense is a current asset. You have paid an expense in advance. So that person has to render you the service. So it's a current asset. Then accrued expense is a current liability. So expense that you are owing, it is a current liability. It's a liability. You are owing an expense. It's a liability. Okay. Then prepaid income is what? A current liability. So we have established that, right? Are you okay with the acronym? And I'm way be more and I don't know. More way be show
Very
We
us.
are
well.
okay with it.
You are okay with this one?
Papa.
Yeah.
Oh,
Yes.
okay. Okay. Information is material. If I think we read something about this, right?
This
Yes.
is A.
Afa.
Papa.
Means you are really following.
The Papa.
Prudence in financial reporting means we also spoke about prudence.
Yes.
A, creating hidden reserves to cover future losses. B, exercising caution when making estimates under conditions of uncertainty. C, understanding asset and understating liability intentionally. D, always choosing the lowest.
B.
What's the answer?
B.
B.
The
You
answer
are
is B.
correct. Alpha.
Papa.
Now we are going to accounting equation. The encore form pen. Because here when questions come under accounting equation, what happens is that they always want you to know the effect of the accounting equation on the business transaction. The effect of the accounting equation on the business transaction. So what happens is that you would have to tell us whether asset will increase, liability will decrease, or capital will increase. You have to tell us. So which of the item is it going to affect? Because the accounting equation is asset is equal to what? Capital plus what? Liability. So our main focus is on these three items. So if anything happens to capital and liability, it will definitely have an effect on what? Assets. So the business transaction you are going to read out there, what's the effect that it will have on the asset, capital and liability? So if you look at the transaction, okay, this one, it will increase assets. Then what will it do to capital and liability? What will it do? Maybe it will increase capital, maybe it will increase liability. And say anytime capital increases, anytime liability increases, definitely asset will what? Increase. That's what you have to put in mind. Because capital plus liability is equal to what? Assets. So that is what we are going to, that's the principle we are going to use here. So question 32. A business purchases a delivery van for 15,000 on credit. What is the effect on the accounting equation?
Asset will increase and liability also increase.
The liability will also what? Increase.
Increase.
Thank you. Alpha. So see, asset increases by 15,000, liability increase by 15,000. One explanation now the man now who answer no preko. So that is what I always want it to be, or how I want it to look like. The explanation itself should give you the answer. So which of the following is a credit entry? Among this, which one is a credit entry? A, increase in an expense. B, decrease in a liability. C, increase in revenue. And D, increase in an asset.
Increase in revenue.
You said?
Increase in revenue.
Yes, thank you. That's
C.
correct.
Hey, please, how come? I was going to
Okay,
choose
so
B.
as I said, I always show you what? Evidence. Because revenue has a credit entry or credit balance. Okay, so the one I was talking about, the accounting equation. Yes, please. You can come with your question.
But then they said income to have credit entry. So
yes, income has a credit entry. And that's why we say
So
increase
it's
into
increased.
revenue. You get it? So, oh, here it is. Here's what we are discussing. So, we said increase in an asset is what? Debit side, right?
Yeah.
Increase in an expense is debit side, right? Right?
Yes.
A decrease in a liability is debit side. A reduction in income is debit side. A reduction in capital is also debit side. Now let's come to the credit side. A reduction in an asset is credit side. A reduction in an expense is credit side. An increase in a liability is credit. An increase in income is credit. Increase in capital is credit. So let's say you've taken note of this. You have this in mind. Now let's go back to the question. Yes, please.
So increase in an asset. Me as an organization buying an asset, it increases. How
Yes,
about the expense? I think I've asked you this question before. The expense. Why is it at the debit side?
Why is the expense at the debit side?
Yes.
Okay, so the idea is that with the expense, you pay for it, right? It's a cost to you, more like a loss. So you pay for it. So what happens is that when you make payment, whenever you make payment, the cash account is always going out. Like the money is going out from the cash account. So you are crediting your cash account. So the corresponding account becomes what? A debit.
Okay.
Because in accounting, everything is a double entry. So if you don't get the double entry right, that is where we are making errors. Na correction of errors, baby. But if we get the cash right there, then it means we have to get the corresponding entry right. So always in your cash book, you know that payment is made at the credit side and receipt is received at the debit side. And we know
Very
that
well.
cash is an asset. Is that not it?
Okay.
Cash is an
Okay.
asset.
So the same analogy, liability. Maybe I'm paying a loan by cash.
Yes.
So the cash account, the credit side would release the cash, and then in my books, I will debit the loan
The
account.
loan account. So what does
That's
it
why.
mean? What does it mean? It means you are reducing your liability. Is that not it?
Okay. Yes.
Yes. Yes. Then if it's income, you are increasing the income in the statement of profit or loss. You know that when it comes to income, it's credit. It's credit. So whenever the income is coming in, cash will receive it at the debit, then corresponding credit goes to the income account.
Yeah.
So if you like, if you want to know the entries very well, just use cash to analyze it. You can use the cash account to analyze these things. All these things here, you can use the cash account to analyze them. So you are buying an asset. Okay, an asset is coming in. So you are receiving the what? The asset. And you are paying money to buy the asset. So cash will be credited. The asset account which is being received will be debited.
Hello, Sir Jude.
Yes, please.
Yeah, it's 7 minutes past 12, and I don't know whether we can.
Yes. So that's what my boss communicated with me, that I should break you. So I'm going to break you.
Say, Jude.
Me, if it's not a yeah, come here, I'll teach you how to me.
Your
Like
hype man, I'm here.
Then
Your
when
hype
you
man,
come
I'm
back, let's continue, sir.
yes, you continue, pa. So
Because the end of the year, not for profit accounting and accounting.
oh yes, they will be featured in it. So I'm very particular about those ones too.
Thank
So
you very much, sir. And
you are welcome.
you made me understand this part one more time.
Oh, okay.
Thank you.
You are welcome. So we will have a question too on accruals, and you know how it will
Yeah.
also be affected.
Yeah.
So when are we coming back? What time?
Sergio, please,
Uh,
I want to find out.
okay.
Can we have access to this after the meeting to go over it again? Is it possible?
Because of the Zoom, no, because this one is Zoom recording. Because of the Zoom will tell us that if it is ready, but it will be ready today. Now, today, you get it.
Okay, that's good.
Yeah, if it was my personal recording, the other one is different. But this is Zoom, so Zoom will have to work on the video, that kind of thing, and send it back to us. Then we will push it. So I am discussing with my boss. He said the advanced taxation people to also be using the link possibly. So immediately they finish, I'm sure it will be by evening. It will be in the evening. So evening, let's say 7 we are continuing. 7 we are continuing.
Ah,
And
so
tomorrow, God willing, too, we are meeting. We are meeting
So
tomorrow,
after
God
the break,
willing.
you're not coming again.
You said
After the break, you won't come back.
you come back at 7.
can't you make it around 2 or
I thought it would end at 2.
7 is too
Yes,
far.
please.
Can we do
Then
around 2 or
let
3?
us continue.
no
They
no
said they
no.
have
Let's
advanced
come back at 2.
taxation. They have advanced taxation. So
But we
Or
can leave at 2.
practically, they said from 7 to 1. So we actually have 1 hour more.
okay.
So I'm sure, like what he's saying, we have to also be fair to the organization. They are doing.
Sergio,
Yes, please.
please, can you use your Gmail, the Google this thing to do it for us?
Okay.
Around
Then
2.
that'll be fine. So let's say 2 will come back.
Yeah,
It will
Yes.
be posted
because
in the main group, right?
You said
The link will be posted in the groups.
yes. I'll send it to all the groups. The
Okay.
four, no, na. Akoya assemble.
So you
Pacho.
we just don't want to say to rest more. So
So,
the
No,
would have
Sergio,
been
there is
Sergio, please give us your number, give us your contact, so that
Okay.
if you post that, maybe we can contact you personally to send us the link.
So that will be fine. So that those in the group 4 will also.
So give us your contact.
Okay. So 02048 4866 779.
Please, do you receive call on
Oh,
it too, or it's only for WhatsApp?
So the call line too is 059
Hmm.
238 7022.
Thank you.
You are welcome. Miss Ronnie.
yeah. Is that
uh,
plus
I'm
with
not
the number?
the number.
Is that
020
plus inside?
02048667779. That's the
So
first
that's
one.
7.
That's the WhatsApp.
Yeah.
Then the call line is 059 237 022. And I also 10. 1, 2, 3, 4, 5, 6, 7, 8, 9.
I think you said 05923870222.
238. Good. So me who say so 10. Good. So that's it.
Okay.
Okay. So we are coming back at 2, right?
Yes.
Okay.
And please wait. Tomorrow, what time will we meet?
Tomorrow I wanted to do it morning, but you people will tell me you are going to church.
No.
The
Okay, yes,
morning, the
I'm going to
network
check.
is always
So
better.
evening.
Sunday mornings,
No,
the
but
higher network is good.
okay, if it's in the morning, what time will we start? What time will we end?
That is the we are going to end around. We are starting morning 5.
Mm-hmm.
So we are
No,
starting
let's
5
let's
p.m.
let's go to church and come so that we'll go and pray for God to bless our brains
Oh
so
no,
that
we
Uh,
can start 5.
Morning is better.
Me, my church is at 10.
it's at 10. Because I've
Yes,
had
that
a class with someone like that before. From 5 a.m. Then we closed around 9:30. Then the person went to church. So I don't know about.
And we don't know the others, but it's
yeah.
okay for me. The 5 is okay for me.
Mm.
Me too, it's okay for me.
Mr. Savior, do you agree?
um 5. Yes, I can join at a point, but I have to leave. Okay, so
Okay.
if all will agree on the 5, I think I'm okay.
Okay. Okay. So we are coming back at 2 to continue.
Okay, thank you very much, sir.
You are welcome.
Thank you.
You are welcome.
Can you please tomorrow? What time?
Please said
Tomorrow, what time?
tomorrow's time is 2. Hey, I said 2. It's 5 a.m. 5 a.m. We are starting at 5 a.m.
Some of us. Okay.
Try. The exams is approaching. Try. Okay. Mhm.
So we'll meet at 2, please.
Yes, please. 2.
Okay.